That was officially the walk-on music, so I walked on. I'm Jay. Hi, everyone. Welcome to everyone in the room and those joining us online. My name is Jason Healy. I'm a senior research scholar here at Columbia University School of International and Public Affairs. On behalf of my the co-organizers, Trish Mosser here at SEPA and Danny Brando of the Federal Reserve Bank of New York. Just welcome. We're really excited. This is our 7th conference on cyber risk to financial stability. We started this, Trish and I, this project, not quite 10 years ago, to say, boy, there's been a lot of focus on individual banks and cybersecurity. That's how I got my start in part of this field, working at Goldman Sachs with folks like Stuart Pomerantz. But there hadn't been a lot of work up to that point to say, well, what about macroprudential stability? How do we think about the systemic risk to the sector as a whole, which is what Trish was an expert in, and how does cyber affect that, which is what I knew very well. So Trish will be running the first panel, and we call this, it might catch your attention that we call this the State of the Field Conference. This is a concept I picked up from my longtime colleague and SEPA adjunct faculty, Greg Rattray, who we will be hearing from later on today, to say if you really care about a field, you have to periodically come back and revisit it to figure out what's changed since the last time. And you need to do that in a structured manner. So this is the 7th one of these, and they always have the same structure. We start always with, what are we learning? In the year since we met last time, what new knowledge do we have about systemic risk to the financial sector? Danny Brando from the Fed will be picking up the second panel, which is, okay, so what are we doing about it? How are we mitigating these risks? And so in those, we have everyone from the ARC to the FS-ISAC over the years, different companies, different industry associations that have all been saying, what have we done since last year to help buy down this risk? I'll be running the third panel, which is, again, is always the same. It's what's next. Until the next year when we meet, what can we be anticipating? And of course, today, partnering with SEPA's IGP, Institute for Global Politics, we have a fabulous spotlight interview featuring Columbia's Jack Lew, the former Secretary of the Treasury, and Arvind Krishna, the CEO of IBM. So a fabulous, wide-ranging conversation that's going to be covering technology and regulation and the finance sector and everything that you might imagine. 2 brilliant folks to be talking about during that. In between, we'll be having introductions by SEPA students and SEPA alumni that have gone on to the New York Fed, and they'll tell you who they are. Our thanks to our sponsors, so including the Institute for Global Politics, as well as Columbia University's Data Science Institute. Our thanks to them. And you'll also see a booth out here from Andesite. And many of us talk about the impact of AI and cybersecurity. They're a company that's been looking to use AI to look at how to improve security operations centers and actual security operations. So we thought that would be a great way for folks to learn something about that by seeing it. Our thanks to the team, especially my deputy Irva, to Charles, our RA, who's helping today, to the events team, Daniel and Susan, as well as all the folks from facilities and securities, and the security team that are helping with that. So today we are live streaming. The recordings will be available, except for the second panel, which we run under Chatham House. So our apologies if you're watching online. The cameras will go dark for the second panel. Just because we are talking about how we're mitigating risks, we do need to make sure that people have the opportunities to be able to speak and know that to speak more freely under the Chatham House rule. With that, I will pass it to my colleague, Trish Mosser. Trish.
Thanks, Jay. I'm going to be very quick. Welcome, everybody. Welcome to Columbia. Welcome to SEPA. One of the little backstories about, my name is Trish Mosser. I am the Director of Central Banking and Financial Policy, so not a cyber expert. although at this stage I know enough to be just a little dangerous, I think, probably. But Jay's quite right. We've been at this for a while, but it did take us several months to figure out how to talk to each other when we started this project. So we understand the differences in approach between mitigating cyber risks and how economists tend to think about financial stability. So in addition to this conference, the Project on Cyber Risk to Financial Stability hosts a research seminar several times a year devoted to discussing new research on cyber risks in finance. The participants in that workshop are researchers from both the cyber world and the finance world. And they include folks from academia, from policy institutions, both economic policy institutions and security policy institutions, think tanks, and so forth, as well as from the financial services and cyber industries. So it's very broad. I'll give a plug. All three panelists here on the first panel I'm going to chair in a minute, papers were actually presented this past year in that seminar. So my plug to all of you is, if you know of research or you're doing research yourself, please let us know. We don't think anybody else that we can find is actually hosting a seminar devoted to this topic, so we'd be happy to have more research, and we want to encourage more research in this world. So, welcome. Glad everybody's here, and I'm going to turn it over to Danny.
Thanks, Trish. I did request a milk crate, but they didn't give it to me. So. All jokes aside, my name's Danny Brando. I'm from the New York Fed. I'm currently the Deputy Chief Risk Officer and Head of Enterprise Resiliency, but I've been at the New York Fed for 22 years in various roles, from defending the institution from cyber attacks and leading incident response, intelligence, and forensics, to cyber policy for our financial institutions. But I wanted to add a brief welcome message to my colleagues Jay and Trish's excellent introduction. Thank you all for being here. Thank you, Columbia, for hosting events like this. This partnership that we have between the New York Fed and Columbia is one that we deeply value. As they mentioned, this is the 7th conference, which is a testament to Columbia's sustained commitment to this program, and on top of that, how incredibly important this topic is. Through academic research, practitioner engagement, and convenings like this is how we will build that strong foundation for managing and mitigating cyber risk. So for this first panel, as was mentioned, it is what we are learning, and I think it sets the exact right tone for the day. We'll hear about measuring vulnerabilities in banking, uncovering supply chain risks, and understanding potential catastrophic cyber losses. These are the questions that we need to explore as researchers, as practitioners, and as policymakers. So thank you again, Jay, Trish, and the entire Columbia team for putting on a spectacular event. I think we have amazing speakers to help us dive really deep into these topics. So with that, I will turn it over to Trish to get us started. Thank you.
Thanks, and please, if Steve and Ben would come up, I think we should be able to see slides while you're doing it.
Perfect, thank you.
So I'm very pleased to introduce this panel, and the individuals on it are exactly representative of the distribution of the kinds of researchers that we think we need to be tackling this question. I'll introduce all of them briefly now, and then we'll just go straight from one presentation to the other. That's okay. The first presenter will be Ben Edwards, Principal Research Scientist at BitSight, the cyber ratings firm, and he's going to discuss his research on global IT supply chains and concentration risk. Second, Tom Johannesmeyer, who's going to join us virtually, co-directs the Economic and Legal Warfare Project and is a PhD candidate, almost done. I think literally he's defending in a week or two, at the University of Kent in the UK. And he's going to present his research on sizing cyber losses. Last but not least is Steve Baker from the Federal Reserve Bank of Richmond, senior financial economist, and he's going to talk about his work predicting cyber vulnerabilities in banks. So without further ado, Ben.
Thanks, everybody. There we go. I really appreciate being here. This is not my usual audience. I'm a cyber nerd. I got started doing data science in my PhD program in computer science and wanted to focus on security and data science because I think those are the kind of most interesting things. I fell backwards into looking at supply chain risk because it's a really hard problem. And so I'm just pleased to be here to talk to you folks about some of the research we did on supply chains and kind of maybe give some stuff on upcoming research and what I think the big problems we're going to try to address are. So given the title of the conference, I think lack of visibility is the major risk to financial stability. Because we can't really know how to anticipate risks. We can't really know how big incidents are going to be if we don't know how things are connected, if we don't know where the concentrations are, and how we can potentially prevent them. And just to be illustrative of that point, we have had numerous incidents in the last decade or less than a decade that all seem to be some sort of surprise. So for example, we have the solar winds, which for me is really like the supply chain incident where we have a kind of relatively small unknown supplier who happens to have like huge downstream effects just because they supply to the US government in a way that makes them really critical. There's been a number of other ones that I think are really interesting. There was a small library called XZ, which I'll talk about in a little bit, which was had one maintainer and was critical to the OpenSSH library and nearly caused a backdoor in essentially everybody's server in the world. And then we can talk about others that have surprised insurers. The CDK attack, which essentially was a ransomware attack that meant every car dealer in the nation couldn't operate for a few days. My insurance friends were very disappointed in this one because there was a lot of business interruption. And there's a lot of business interruption policies out there. We could talk about these all day. I think one of the most recent ones, which I'll talk about shortly, is the recent light LLM breach for PyPy. And this is like a actually fascinating incident to go into detail, but I'm going to talk about kind of why we should be concerned about that in particular at a later slide. So being a data scientist, the first thing I like to do is kind of level set on what our data set is and kind of where I'm coming from with this research. So at my company, and I understand I'm in industry, so I have to talk about company data and corporate stuff that is not necessarily public, but what we do is we measure when organizations use a supplier based on scanning technology, based on natural language processing, and any number of kind of connections that we can make between this organization uses Apache, or this organization uses Microsoft, or AWS, or various types of provider-consumer connections. So what this breaks down to is we have about 62 million connections that I'm trying to measure, spread across 500,000 consumers and about 250,000 providers. Now, I'm using this in terms that will cause economists to probably cringe because everybody is a consumer and provider in an economy, right? But in this case, consumers are the ones that are the leaf nodes that I don't know who they're providing to, so we're going to call them consumers. It's convenient for me. Along the way, we'll measure things like cloud providers and other things. So this hairball that we have on the right is maybe not the best data science visualization I've ever made, but I think it gives us three things. One is that when we talk about supply chains, we're not talking about supply chains, we're talking about supply networks, obviously. Two is that it's incredibly dense and interdependent, but it's not clear whether that makes it resilient or fragile. And it's really complex, and if we just kind of look at a simple state of things, we're probably not going to get a lot of information. So to speak to that, which providers are probably the most important? And this is actually kind of a hard question. We can look at connections in that giant hairball network and ask who has the most connections, but that belies things like some of the consumers are more important to the global economy than others. And so what we try to do in this research is take what we call market share. We're going to take kind of the weighted number of connections an organization has by the revenue of their consumers. and then average that over all the consumers that we have. And so since we're looking at digital market share, here's the group of 90, critical 99 we call them, sorry for the marketing term. It's 99 because it fits nicely in 3 columns, and that's more aesthetically pleasing than 4 columns of 25. But what you can see here is companies we largely expect at the top, and some maybe we don't. So Microsoft, Google, Oracle, these are all organizations that we know are critical tech providers. I think jQuery at the very top is an interesting example. This is a JavaScript library that everybody uses to build a website. Nobody's website works without JavaScript, but it's maintained by about 6 people, and it's open source. It has backing from major companies because it's important, but it is still an open source thing. I will allow you to go in the paper and talk more about these, but I will say some of these providers are not critical. In the sense of Meta, most of our measurements are looking at things like the metapixel and ad tracking. That's probably not going to ruin your day if it goes down for a few hours, but regardless, it's well used. Now, going back to our incidents, we can see that some of them are actually concentrated. So CDK, for example, I'm going to try to move away from the mic, is down here at 1.4%. Thank you. See, I move around too much. I'm too animated. It is on. Fantastic. They're about 1.4% of the global economy, but about a quarter of car dealerships. So had we known this, we may have said, hey, that's critical for car dealerships, and we should be concerned about it. CrowdStrike, 10% market share, but it was a little bit more highly concentrated in airlines. So when we had that incident in July, that's a thing. So we can start to look at some of these concentration risks along the way. We can do the same for a financial sector, and we see that some things hop out. So instead of coloring this by the kind of absolute rank, we're going to cover it by the ratio of the global market share. We see things like Bloomberg for the financial sector is really important. They provide data, right? And so we can start to concentrate some of this risk. We can also look at, say, for example, where in the cloud ecosystem folks are concentrating their risk and what services they're actually running. This is public information. We can scan data. We can look at various IP addresses and say, hey, it looks like manufacturing has an over-reliance on EC2 compared to other industries. Okay. Big providers are not the most important providers. And I mentioned this a little earlier. There are 2 open source libraries that are incredibly important, OpenSSH and the XZ utility, which is actually a dependent of OpenSSH. There are literally millions of OpenSSH servers all over the globe. This is a visualization of those. It's maintained by 6 volunteer developers, 3 of which were the founders and have been doing so for decades, right? This is critical to the global economy, and it's like a tiny piece of open source software. The XZ utility was maintained by a single individual, which is why it was nearly compromised because another person came along and volunteered to become a maintainer. And that was a threat actor from a foreign country. I couldn't do this talk without talking about AI. Among the products that we're seeing rise in popularity are these AI tools. So for example, OpenClaw, this is one of the fastest growing GitHub projects ever, right? And it presents a huge security risk. People are adopting these tools because they're incredibly useful, but we should be careful about that adoption and what it means to our stability. This is another graph. This one's actually instructive if you could read it. We have Light LLM at the center. This is this tool that was compromised a few weeks ago. These are all the dependent libraries that depend on Light LLM. Meaning, if you installed any of these things, such as like an OpenAI library, some of the Google Cloud libraries, they will pull them in. They will pull Light LLM in, which was for a time a malicious package. All right. My last point here is that security is never guaranteed. If we look at that market share idea I talked to you about and think about ways that we could measure the exploitation, some of these very, very large companies are very, very bad at security. I'm not going to tell you who they are because this is an open forum, but some of them are certainly not doing the best. So for example, there's an EMEA transportation company. They have a 20% global market share, and they're in the worst quartile for insecure systems, meaning as we scan them, we can find open systems that should not be open. US-based marketing company, 14% global market share, an incredible number of botnet infections. About 1 in 8 systems would have a botnet infection in a year. An APAC manufacturing company, 10% global market share, worst quartile for open ports. We find things that should not be open, like FTP and SSH, that we should not be able to scan from the outside. And then this one's my favorite, a Fortune 500 energy company, 30% global market share because they serve incredibly large companies, worst quartile in secure systems. All right. I can't just be the FUD guy and tell you all the scary things that are happening. So how do we address this? I think we need better monitoring and identification and cataloging of these individual supply chains, understanding the concentration of suppliers, where these software are in critical niches, and then support for these foundational parts of the global supply chain. We have folks doing incredible work and doing those things, and we're kind of letting them go on their own and waiting for these incidents to happen. And then, of course, we got to model all these failures. So I am 17 seconds over, but I'm happy to answer questions after we get done with the rest of the panelists. Thanks.
Sorry, can you bring it back?
So,
Excellent. I think that's my cue.
So, good afternoon, Tom. Sorry, let me do this way. Good afternoon, Tom. Welcome. Tom is on, is in the UK. Hopefully, oh, good. His photo is up there. Good. Your video. I was afraid your video wasn't going to be there. Please, whenever you're ready to go, and they will. They're happy to change your slides whenever you'd like.
Outstanding. Thank you so much. And good morning. Actually, my school is in the UK. I'm in Bermuda. So I live among my research subjects. And today we're going to talk about the cyber risk protection gap and the extent to which A, we can measure it, and B, it's manageable. So let's go to the next slide. I think we've got an issue here. I'm seeing myself in all three squares, but not the room.
The protection gap slide is up.
Okay,
If
thanks.
that's helpful.
I can't see. It is. I can't see you guys right now, but if you can see the slides, that works for me. I can pull it up locally and kind of follow the bouncing ball. So let's talk first about what a protection gap is, right? Because it's an expression that gets used in insurance a lot and not always appropriately. There are actually two types of protection gap: the insurance protection gap and the risk protection gap. The insurance protection gap is the one that's it's more forward looking, right? That's where you go out and say, hey, we figure there's 17.6 billion or trillion, excuse me, in cyber exposure. There we go. That is not insured and could be, or there's 17.6 trillion in total exposure. We believe 10% of that is insured. $1.76 trillion in insurance limit is outstanding. Cool. 90% of that needs to be filled. Next is the risk protection gap. And that's retrospective. Like, hey, somebody had a loss. How much was insured and how much economic exposure did not go to insurance companies? So, NotPetya, for example, we all know the public number on that is $10 billion in economic loss. $3 billion of that went to insurance companies. So you could say the risk protection gap on that event was 70%. But if you want to go even deeper, hey, 2.7 billion of that was picked up by the property market. So the affirmative cyber insurance protection gap was a 97%. Now, what's often misunderstood with the protection gap discussion is you see the exposure number, you see the insurance number, and you think, okay, what's in between is what needs to be addressed. Well, when you set the exposure number, you've got to think about economic benefit. So I may have 100 trillion in value exposed to the cyber domain, but I know that the vast majority of that is little stuff that really doesn't cost me anything. It's annoyances that I can get picked up, so I'm not going to insure them. Or it's high frequency events that are almost guaranteed to occur or will occur every other year, which makes the cost of risk transfer prohibitive. So those risk transfer deals are not economically beneficial, which means those exposures are not really considered part of any protection gap, right? So when you think about what insurance can do, what the gap is between economic exposure and insured loss, either forward-looking or retrospectively, you've got to think about, hey, that top number needs to be realistically addressable by risk transfer. So today we're going to talk about the risk protection gap. Let's go to the next slide. And it's one that doesn't get enough attention because risk losses aren't as exciting, right? Previous speaker just mentioned CDK and CrowdStrike, for example. Those are cyber catastrophes, an event that's got a significant loss attached to it and a significant number of victims affected. So back when I was at PCS at Verisk Analytics, for example, we would define a cyber catastrophe as a significant number of insureds and insurers affected, and an estimated industry-wide insured loss of $250 million. Peril's Cyber AccuView is US only with a $500 million threshold, likewise requiring significant number of insurers and insureds. And everybody loves talking about CAT because we're all worried about systemic loss, even though I'm not necessarily convinced we should be to the degree we are. They're big numbers, they're scary numbers. That's where you talk about things like earnings impairment and solvency and so forth. Risk losses are less exciting, but that shouldn't be the case. Risk losses get big. So a risk loss is a single company gets hit. So instead of looking at, NotPetya, where you had $3 billion in insured loss and $10 billion in economic, we would look at Merck, which had $1.675 billion in insured loss relative to an economic loss probably approaching $2 billion. So a single risk loss is the economic impact to a single company and the insured loss borne by that single company. The delta, of course, being the risk protection gap. Now, the reason I want to talk about large insureds is A, because nobody else is, and B, there's some interesting data around this. C, these large programs have an impact on how companies can write insurance for companies of all sizes, right? So if you have an insured with $100 million in protection, that's one company, one exposure, $100 million. That's a lot different from, say, 50 companies with $2 million in limit each, where you've got some diversification, you've got some benefit from the law of large numbers. These are big hits. These are big exposures. And they play a pretty important part of the market in terms of size and how risk manifests. So I think we need to look at these big exposures that a lot of companies are afraid of because you might be getting $1 or $2 million in premium to write $100 million in risk. And it's a terrifying number. That can make it expensive to write large risks, which then in turn causes these large companies to buy less insurance because they deem it less economically beneficial, which ultimately leads to a broader protection gap in the insurance protection gap sense because there's not enough protection outstanding. Let's go to the next slide. Enough of background. Let's look at some numbers, right? So back in my days at PCS, we built a database, it's a little dated by now, of around 250 companies, each of which had at least $200 million in affirmative cyber insurance, right? So cyber insurance written on purpose specifically to cover cyber. During our canvas of the market, we learned that there are probably 750 to maybe 1,000 companies, including those 250, with insurance coverage of at least $100 million for affirmative cyber. Now, when you look at the overall cyber insurance market's premium trend, you can see that we started below $4 billion in 2017 and then worked our way up to last year an estimated $16.3 billion in affirmative cyber insurance premium. When you think about that, large insureds, right, that collection of companies with at least $100 million in premium, likely accounts for roughly 10% of that market. So 10% of the premium is going to these big concentrations of risk. And it's worth thinking about then how that can move the market, right? 10% of premium may not sound like a lot, but you've got big important companies with large amounts of limit, comparatively small premium, that do stand, the risk of cyber attack. And that has been a concern for the market in terms of their ability to absorb risk and generate premium relative to the risk they absorb. So what's interesting, though, is even though these are the big risks, you've got to think about how often they get hit for large claims. Now, let's go to the next slide, where I'll give you a snapshot of my research methodology here, which has been formal-ish to date, right? So we're looking at a large insured loss as a single risk claim of at least 20 million US dollars worldwide. So I started with the PCS Global Cyber Database that goes back to 2013 and has 46 of these events. I carved out events that were associated with catastrophes. So Merck, for example, is not included. Likewise, Nuance Communications, because it was part of a cyber cat, and that made the numbers a little messy. In addition to the 46 I found with PCS, I was able to get 3 more through internet searches. So right away, the question becomes, and I got this a lot when I was at PCS and since, how much are they missing? And it's a good question. Now, we canvassed the market aggressively and would periodically talk to companies that didn't share data with us just as a gut check. We always figured we were probably inside of 15 to 20% misfactor. So we probably captured more than 80% of these losses in the market, and the ones we were missing would be the smaller ones. The 3 I found were all under $50 million. So here you've got to stop and think to yourself on a practical basis, okay, if there are 49 total losses here, could they have gotten half? Could there be another half out there that we're missing? That's credible, right? 2/3, that starts to strain credulity a little bit. And then when you think about the size of the losses that were being missed, they were more likely to be smaller losses because larger losses affect more insurance and reinsurance companies, and that makes data capture easier. And in terms of large insured losses that have an attendant large economic loss, by definition they would have to, those tend to gain more public attention, as we saw during NotPetya, for example. So the miss factor on this data is not as bad as your instinct might think. We certainly leave room for the fact that there are a reasonable number of smaller claims within context that may have been missed. But this is a solid and directionally correct representation of the large risk insured loss data set. So what I wanted to do to get to the risk protection gap then is find among those 49 the companies that had publicly reported economic losses. And Jay and I have discussed this issue at length with publicly reported economic loss data for cyber, risk, and cat. It's messy, it's ugly, but dismiss these public indications at your own peril, right? Even if the data is not given to you with a public and transparent methodology, even if it comes in mainstream media accounts, you need to at least factor in that some editor and some lawyer somewhere let those get into the public domain. And that alone provides at least some amount of due diligence associated with those numbers. Don't take it down to the decimal point, but certainly treat these numbers with a certain amount of respect.
So Tom?
Go ahead. Yes,
Tom,
ma'am.
I'm sorry to interrupt, but we're just about out of time. So if you could wrap it up, I'd appreciate it.
Okay, sorry. I think I might have been penalized for the tech issues at the beginning of my session, but I will keep moving. We wound up with 26 events that have an economic loss and an insured loss associated with them, which gives us the opportunity to calculate a risk protection gap. The chart on the right is anonymized because PCS data is private, and it shows you the large and small of it. Let's go to the next slide. All right, let's take a quick look at what we actually got here. So we had 49 numbers with insured losses only. We had 26 numbers where we had the ability to produce a protection gap, right? So basically, call it 60% in terms of aggregate insured loss is visible in this 26 data set. And that gives us at least a meaningful number to work from. I show you the delta between n equals 49 and n equals 26, just to show you that they're not wildly out of step. Is n equals 26 a perfect representation of the 49? No, it's not. Is it ballpark? Absolutely. And then the big question is, what can we do with these 26 data points? Let's pop to the next slide. Okay, what do we know from what we've seen? Let's start with the fact that in general, there have been very few runaway losses, right? Where the economic loss far exceeds the insured loss. Obviously, Equifax and Merck are at the top of that list. Both were over $1 billion in economic loss. Equifax was probably 90% uncovered by insurance. And Merck is a different situation, given that we did have $2 billion in economic loss, but a big $1.4 billion property insurance coverage that came in, something we won't be seeing again in the future, most likely. Now, additionally, Capital One and Marriott were over 600 million in economic loss apiece, and both actually are the largest and second largest insured losses for the single risk category. So if you take out Equifax, Merck, Capital One, and Marriott, the average protection gap is $82 billion, which is manageable. You know, what this says is we have, and you look at the bars to the right, there's insurance in place for these large losses, and it's material in size. Are there cases where insureds are unable to get enough insurance where there has, basically for people who buy, which is why we're not looking at economic loss only, right? For companies that buy, are they getting enough cyber insurance to cover the risk they face? Based on this small indicative data set in a sector that's still young, it looks good. Now, are there some concerns that, there could be a vastly underinsured company out in this space? The risk exists, but you then have to factor in two things. A, there is a question of insurance availability. And B, you have to think back to the economically beneficial concern where a larger cash-rich company, for example, may choose to self-insure. So let's go to the last slide. And 20 seconds, Trish and I will be done. We do need more data. The universe is small. The data set is small because the universe is small, and that's worth keeping in mind. It's not like there have been large volumes of loss that haven't been captured. The insurance industry is pretty concentrated for insurance and reinsurance. The data is pretty easy to find if you can get access to it. So we do know generally how exposed large risk programs are, and we're setting the bar pretty low at $20 million. So the notion of a cataclysmic large loss, we haven't seen it yet, and the ceiling seems to be pretty low for this sort of risk. So in terms of runaway losses on a single risk space, which calls into question the ability of insurers to meet the needs of insureds with regard to economically beneficial risk transfer, insurers are well positioned to do that. They've got the capacity, and they've entered into this space already. Next, when insurance is purchased, it does a pretty good job of covering the economic exposure, as we've seen. And then finally, for very large single risk economic losses, they are rare. There have only been 4 since 2013 where the economic loss is in excess of $500 million. They came at a very short kind of span of time as well, from 2017 to 2019. And with that, I am happy to yield to the mic.
Thank you, Tom. Next up is Steve, who's going to talk about predicting vulnerabilities in banking.
So it's a pleasure to be here. This is based on a paper that I wrote with a colleague at the Richmond Fed, Demutu. As usual, these are just my views, not the views of the Richmond Fed. So if I say we, I mean me and Demutu, not the bank. It is based on a paper that's available on SSRN and my website, but I'm going to try to keep it kind of high level and casual and just give you sort of a flavor of the results in the paper. So basically what we're trying to do is to take some of the commercially available risk indicators and do sort of an independent assessment of how well they predict the risk of a cyber incident in the banking sector at individual banks out of sample, right? And for this, we're going to be relying upon BitSight data. And it's not that we don't trust our partners there, but we want to do an independent assessment of it. And we also want to do it in a context where, banks, not all of them are public, but we do have pretty good firmographic data for them, and that's kind of unusual. A lot of the existing studies have focused on public companies precisely because there's better data on them. And so this is an opportunity to assess the relative improvement we get from these commercial cybersecurity risk indicators in a setting where the firms are smaller and not public, but we still have good information about them. And so what we do find is that the model that we put together, which is based on, uses a random forest classifier, works pretty well out of sample. It's good at separating the banks that have higher risks from those that have lower risk. And there is some incremental value that comes from having the BitSight risk indicators over and above just things like, how large is the bank, what's its loans to assets ratio, other sort of firmographic characteristics. Okay, and this is nice because the technical risk indicators, are potentially a little bit more actionable, right? If you think about what you're going to do with this information, right? Ideally you would have some sort of a technical basis for perhaps, focusing on certain banks or trying to incentivize, changes in behavior. If the risk is sort of inherent to the business, right? There's not sort of clear what you could ask banks to do about it, right? So there's some value to the technical risk indicators that's, I think, different. They're also harder to manipulate than some of the alternatives that have been proposed. So there are several papers based on, publicly available disclosures and earnings calls that look for sort of mentions of cybersecurity risks, and they do find that they correlate with future risks, but presumably if firms realize that this is attracting attention that they don't want, they would stop talking about those things, right? So those are harder. I think these technical indicators are harder to game. And of course, we're happy that the framework works actually for banks of all sizes, not just large banks or small banks. I think I've already given an overview of the data. For the firmographic information, we're using call reports, and for the risk indicators, the cyber risk indicators at BitSight, and the incident data is from Zywave, formerly advised. And we've got about 3,300 banks represented, and it covers, the data's a little sketchy in 2015, but it gets pretty solid around 2016 and goes through the end of 2024. I'm not going to talk much about the methodology, but basically we're going to be assessing how well the model predicts using area under the curve, which is a pretty standard thing to do. Values above 0.5 means that the predictions are better than random guessing, and actually we're going to get very high values between 0.8 and 0.9, as you can see here. All right, so there are 3 lines on this plot. And what we're looking at is, first of all, how well you do using just bank characteristics. Okay, so this is the call report data, and this is in red. And you see already, actually, that does a pretty good job of sorting banks by risk. Interestingly, the BitSight data alone also does a pretty good job, right? So one thing to maybe mention is that if you were looking at firms where you didn't have such good firmographic data for them, small firms, right? Potentially, the technical risk indicators are a substitute, right? So that's one thing to think about. But if you've got good firmographics, that seems to capture a lot. The nice thing is that when you put these two things together, you get the green line. And the green line, it's not huge, but there's a pretty consistent 3 or 4% wedge between the two. And also where the performance of the individual characteristics or bit site indicators alone seems to fall. So for example, around 2020, the green line seems to pick up some of the slack. So the combination of those two sets of variables seems to be a little bit more robust than either of them individually, which is nice. This is just a plot of the importance of each of the risk indicators. You'll see size is very important, right? And this is true. Here we're measuring it using the log of bank assets, but also there are other measures, like number of depositor accounts and things that work pretty well too that aren't in here. So size, however you measured it, is very important. I think this is not a shock, right? That the bigger the target you are, the more attacks there are. But after you get through size, deposit to assets ratio is very important, loans to assets ratio. But the fourth item there is web application security, which is one of the bit site risk indicators, right? So those are quite important. What we're going to do in the paper is we cull the risk indicators that don't seem to be very important, right, and focus on the ones that are. So in the next slide, there are two parts of the paper. One I'm not going to talk about today, and that's sort of the interpretation of the bank characteristics. And actually, that's something where when we presented at the seminar here previously, we got some useful feedback on that. Today, I'm just going to talk about the bit site risk indicators and a little bit about how they react. So the scale here is that it's sort of like FICO. So if you have an 800, that's a very good score. It means you're considered to be strong in that respect. If you have a score of 300, you're very, very poor. All right. And so for the most part, what you would expect is that the higher your score, the lower the rate of incidence. And that's what is being shown here. These are partial dependency plots from the random forest model. And what they're showing is if you adjust just a single variable at a time, what is the incremental reduction or increase in the likelihood of an incident over the next year. Right? So that's what's being shown. So most of them go in the direction you'd expect. But there's a little bit of a trick, which is that they are nonlinear, right? So as you get towards a near perfect score, for example, the web app security and the TLS SSL certificates, they tick up a bit. One possibility here is that a perfect score may mean that perhaps the firms are shielding information well and not all that much can be measured. I don't remember exactly what the default score is, but I think it's pretty close to the top for those. Interestingly, the one thing that goes in the wrong direction seemingly is the DKIM records, and there the default score is where the kink is. This is something we did chat with BitSite. I know we're not the only ones to find this sort of surprising relationship. I don't have a fantastic explanation, but we did do a little bit of analysis that is not in the paper, where we looked at after an incident occurs, do any of these metrics change? And actually, there's some evidence that DKIM records tends to improve after an incident. So this may be something that firms can kind of easily tweak to get their score up, but then incidents are persistent. so that may be what's going on here, is that it's picking up a little bit on persistent risk. Okay, there's some interesting interactions. So in particular, if you tend to be bad at patching and bad at some of the sort of communication protocol things, those two things, two weaknesses kind of multiply with each other. Right, so this is a graph of the interactions. One thing it's trying to establish is that there aren't strong size interactions, which is nice because it means we can keep the same interpretation of the risk indicators for banks of different sizes. And then the sort of the color plot at the right, which I'm sure you can barely read, it's just trying to show that the interactions are amplifying rather than offsetting, right? So you have the highest risk where you have bad patching cadence scores and, for example, bad TLS SSL configuration scores. Okay, so there's more in the paper. I'm going to stop there for today. I think I'm just a little bit early. Okay, thanks.
Great. Thank you. To summarize, just for the record, when we do these in a workshop, we have like an hour and a half. So hat tip to the three of them to manage to make this comprehensible in 10 minutes each. It's not easy, since obviously some of the techniques are pretty complicated. So we have a little time. I am going to open it up for questions from all of you, but I have one question. I'll take moderator's prerogative. And so this is relevant to all your papers, even though they don't directly necessarily address it. Tom's historical data, for example, suggests that maybe resilience and recovery is, maybe we're not doing such a bad job at prevention, but resilience and recovery maybe is if we were going to focus more time, maybe that would be where you'd focus it. And obviously your papers talk about prevention through identification of risks, right? So there's a limited amount of time, whether you're a regulator or whether you're in the industry, and money about where you're going to focus your attention. An awful lot in cyber has been focused on prevention, obviously, and risk management. I have to say the financial stability person in me is quite concerned about whether we're actually spending enough time and money on resilience. And maybe also to Tom's data, it reminds me that we really haven't seen the black swan here yet. And it worries me that if we see the black swan, that it's going to be recovery that's going to be more important. Anyway, I would be very interested in your observations on that, if you have them.
I will jump in here. So I think from a cybersecurity perspective, recovery is probably equally important at the very least, because no matter how many controls you have in place, no matter how technically proficient your IT team is, eventually somebody is going to click on a phishing email, or you're going to have a build system which operates absolutely correctly, but a hacker gets a fourth downstream party package compromised, and it gets sucked into your system. We should treat these things as endemic. They're always going to be. You're never going to be able to have perfect security. So we should have some resiliency in them. To bring in some data, and this is going to escape me who the company who released the report, other than my former employer, Scientia. We're looking at incident responses for ransomware. And they found when an organization had backups, guess what? They didn't pay ransomware as often. When they had backups that they actually tested, it was even less. So it's not just about like having that resiliency in place with backups. It's also about actually testing them and doing those things. So certainly we have measured effects there. We should do more to quantify what those effects are, but you have to do both. I wish we could prevent everything, but we're never going to do that.
No, we won't. And I think it's important to remember that, every security measure, is not going to be 100%. And we live that way with physical security, not just cyber security. I want to go back to the Black Swan discussion, though. I always bristle a little at the word yet, because, the question remains, have we seen it already? And we've seen as bad as it realistically gets in the security environment. I've looked at historical CyberCat, again, the messy data that I mentioned earlier. But what stands out is we've seen what is bad on an economic basis, and cyber has not come close. So I do think that we have to have some amount of consideration of the historical record on this to understand, is a black swan in the conventional sense really possible? Or are we just thinking an event of unprecedented severity relative to past hits? And I think recovery is key to that. It's not just prevention, it's the speed with which you can get back to life. And what's interesting about cyber is recovery compared to physical impairments is a lot easier. My go-to example is Hurricane Ida in Louisiana. The power grid had more than 30,000 individual repair points. And sometimes to get to them, you had to go through flooded roads and debris and other unsafe conditions. So you had work before you could do the work. That's what makes recovery a lot more expensive in the real world than it does in the cyber domain.
Yeah, so banks are required to have fallback plans, and maybe this is part of the reason why we haven't seen the large losses so far in the financial sector. But it is something that we're that I'm interested in assessing as a researcher, and a lot of what I'm working on right now has to do with getting at that loss distribution, right? The thing that I presented here was about the likelihood of an incident striking, and the next step is actually to say, is there a substantial chance of a large loss, and is that coming from mostly tail risk that is very hard to estimate, we have looked at this a couple of ways. They're not finished yet. Hopefully there will be a paper in the future, but we looked at, for example, market reactions, not just in the financial sector, but broadly at following a cyber attack. And there are a couple of papers out there that do show that cyber risk seems to be priced as a risk factor, and also that following an incident, there are measurable declines in stock prices, and that's sort of one way of getting at least market implied estimates of perhaps tail risk too, to the extent that observing one incident at a given firm might suggest they're vulnerable to future incidents, right? That's kind of baked in there. So that's one thing, and of course the other thing you can do is to look at these technology networks and what have you, and try to do some simulation work, which is also interesting.
A related question, I'm going to make it a comment though, is that it raises the question about whether we have a peso problem really sound like an economist, but a tail risk that hasn't shown up yet in terms of the way asset prices react to cyber, not to mention we might have an economic version of a peso problem with how much is spent and where they're spent and where we're spending on cyber resiliency. Anyway, an open question, obviously. Topic for another set of research papers in the future. All right, questions from all of you. Yes, please. Oh, wait a minute. There's a mic coming.
I was surprised that none of the presentations dealt with qualification of cost. There's a difference between $1 million has been transferred out of my account, it's cash, it's money, and loss of intellectual property, PII losses. Huge differences in terms of the ramifications to the business. If my business has lost $1 million in intellectual property, giving me the $1 million back doesn't make me whole. And so I was curious about how you extend or expand your research to deal with the other types of costs.
I'd like to jump in here first because the economic and insured losses we reported do cover the wide range of expense, right? So, if you are breached, let's say you do have PII costs associated with consumer monitoring, you do have remediation internally, you've got forensic audit, you've got crisis counsel, you've got IRPR. So the insurance industry does take a broader view of those issues because it covers those costs, right? Couple of things. Intellectual property, I'd be very, very careful. We always talk about how it affects you for 10 years and so forth and so on. But the uncertainty that comes with time makes it more complicated because, you may say your idea was going to carry you for the next 10 years and produce a certain amount of return. But if the market catches up with you more quickly, it wouldn't have done that. If the market pivots on you, it wouldn't have done that. If your execution is poor, it wouldn't have done that. So I've always felt that those numbers are a bit overestimated and overhyped on the IP side, simply because there have been very, very few cases where IP losses have had a material impact on a company's ability to generate its target returns and so forth. When you look at other forms of theft, they tend to be priced into the economic and insured losses pretty quickly. So it's kind of in the bag. And then just one thought on asset prices before I yield. When you look at kind of share price as a consequence of cyber attack, you need to look at a longer term view. Target in 2013 is or 12 or whenever it was, is the classic example of there was a cyber attack, but their performance in Canada may have what caused the share price to go down 5%. The big hits were Equifax, which was largely back within 6 months. SolarWinds is the case where they got absolutely hammered and never turned it around. Merck barely moved. So realistically, Trish, to your point, a lot of this is priced in, and a lot of it's priced into the recovery as well. There are very few cases where a cyber attack has had a meaningful and sustained impact on share price. in the end, you don't need to get, if you get your $1 million back, it doesn't replace the IP. But if you use that $1 million properly in communicating with your shareholders and other stakeholders, you'll get that shareholder value back, kind of multiples of that 1 mil.
Questions? My reaction to your, sorry, I'm going to take moderator's privilege here. My reaction to that was thinking about a financial institution liquidity, because when liquidity goes, unless the insurer is ensuring that liquidity loss in real time, that starts a cascade, right, across the financial services industry very fast before the insurer has a chance to step in. It's a timing thing, not an insured loss thing. Interesting.
Yeah, where it's dead to right, you might see ex gratia payments come in. And as we've seen in past financial crises, there are workarounds in the near term that can help as well. So it's not necessarily a fait accompli.
Yeah. But it's the reason people in my world, central banks, are incredibly concerned about is the liquidity issue right there. Anyway, other questions?
Can I?
Oh, I'm sorry.
No. I wish I had a more targeted answer for you, but because I don't remember the name of the paper, but I believe one of my colleagues, Filippo Curti, has a paper on cyber vulnerabilities and IP risks. So I will try to get it to you if you're interested.
Yeah. Yes, please.
I just want to push back on the comments about the lack of record of IP. This may not be cybersecurity, but if you go back as to the 80s, we have seen an industry, business after business after business that tried to succeed in the U.S., typically small to medium size, enter into partnerships with overseas actors that did not follow and obey the laws on IP, and there was no recourse. And we've seen those businesses fail ad nauseum. And one of the biggest challenges is any sort of cyber protection for small to mid-sized businesses, because they can't afford it. So I don't have facts, it's anecdotal information, but I am concerned that this is a bigger deal. Okay? We've seen public papers about the Defense Department having to re-engineer top-grade military equipment because significant features were exported illegally. Okay? So I can't say that the loss of IP is not a big deal. So
I wouldn't say big, but certainly manageable. So the Defense Department case you just mentioned was the F-35. I focused on that in a paper I wrote recently for CSINT over at AU. And it was roughly $100 million in economic effect. But what it highlighted was the problem within IP theft of incompetent actor theft. Right? So when you think of IP theft, the nightmare case is I steal your stuff, steal your business, do it better or cheaper or whatever, and drive you into the ground. That requires that I be able to use those materials. So with the F-35, what happened was the secrets were stolen, but the theft did not have the capability to use them effectively. Yes, it required some project management changes. Yes, it required some reengineering. $100 million in the scope of that extremely over budget and over time project needs to be taken into account as well. Anecdotal evidence is compelling, right? We feel stories. Harkening back to the CrowdStrike issue mentioned earlier, we all know what it's like to be stuck in an airport for over a day. But that doesn't necessarily correspond to economic loss, like as CrowdStrike shows you, as the F-35 case shows you. And instances in the 80s are certainly relevant as a historical data point, but you've got to take that within the context of how the IP environment has changed, how actors have changed, and what they're seeking to accomplish. Is IP theft bad? Absolutely. Does it have an economic impact? No question. Does it necessarily mean you're toast when it happens to you? No.
Okay. Yes. No problem. Yes, right here, and then over here, please. Maybe we'll do 2 questions before we run out of time.
So I want to look prospectively. A lot of the data is retrospectively, and so my question is about quantum. Clearly, we know that quantum computing is going to have an impact on encryption, very important in the banking industry. What's your sense of what it means going forward, and how is it going to change the data?
Why Why don't we go ahead and take the second question if you don't mind,
Yeah,
and
no, we
people
can
can
do
pick
both.
which one to do them both, please.
Yeah, thank you. My question was pretty general in nature. It sounds like from the findings of these papers, though, we're seeing that generally speaking, the loss is manageable. That's kind of the theme I'm getting. So if that is the case, obviously banks, highly regulated, you have to have a substantial cybersecurity workforce because of compliance. But how do you think that these kind of findings will impact cybersecurity budgets moving forward if they're finding that, okay, we're able to ensure our losses? Do you think that, like, will it result in general, like, cybersecurity cuts? I'm just curious on that.
So I would like to talk to the quantum encryption piece. So I think there's two main fears for organizations with Q Day coming, which seems to move up with every press release from Google. One is that there are threat actors who are already obtaining and storing encrypted information in the hopes that with a valuable quantum computer, they will be able to decrypt it and then pull secrets or pull private information out. Now, as time goes on, that information becomes more and more stale, and so it may not be useful even if they've stored it, in the last year. But that's still a threat. And then the other question is, of course, if people are using insecure channels when Q Day eventually comes and a threat actor has access to it. With nation state actors, I can see that happening. One thing that we've observed is that folks, especially in the financial sector, are adopting it quickly. It is enabled in lots of open source software, whether that's the OpenTLS and OpenSSH, both support post-quantum cryptography, and folks are enabling it. So we are not 100% there. We're not very close, but we are moving in that direction. So I think from that perspective, we should move as fast as we can. These are often configuration switches, and IT folks will tell you this is hard and this is going to break things. And yes, but it is just absolutely engineeringly possible. So I think that's a threat. I don't know that it's the biggest one yet. I'm also like a little. Everything, and this goes for AI too, everything looks like an exponential until it's actually a logistic, right? And so we don't know if that if the quantum exponential that we're seeing now is going to top off at some point. Same thing with some of these models, although I keep expecting AI to do this and it hasn't. So maybe we're close and maybe we're not. But I think we have the tools at this point. I think more to the sense we have the tools for this than other threats. So.
Yeah, I thought that was a great synopsis on the quantum thing, so I don't have anything to add there. But as to the question about the loss distribution, so the paper I presented today doesn't actually have any implications for that at all. It was just about the likelihood of any incidents. So but I think we've already kind of covered that evidence so far is that the losses are small, but the debate is whether we're really capturing the tails accurately or not.
Yeah, as to the security budget question, I want to make sure we get you an answer on that. I don't think the experience we've seen is going to get people to just start cutting security budgets. A, the threat is present. B, the cataclysmic problem hasn't arisen. And, be that the tail scenario or just a big hit on a single company, it's been manageable because it's been managed. And as you still, endure attacks and, become a target, you're going to keep investing in security. I mean, I'm a cyclist. I buy a new bike helmet periodically, even though I don't fall, right? I'm going to protect my head. And security is largely the same. Yes, there's a temptation to take your foot off the gas a little bit, but when you see the threat environment and you do your job properly, you know what's at stake. You don't need a massive hit to have some sort of operational impact. So, I think we're going to be fine. I think folks are going to keep investing, not just in what they're doing, but also in improving.
Can I slide one thing in? The other tension we see when we actually talk to CISOs and professionals is like, hey, I'm doing a really good job. I don't have incidents, and they want to cut my budget because I'm clearly paying too much if we're not having incidents. And then we have an incident, and they say, what, we pay you all this money and we had an incident, what are you doing? So I don't know that the fact that you can insure the losses is going to be a greater tension than those things that CISOs already experience. But we do see like more consistent budgets. Boards recognize that these are real threats to their bottom line, and so are willing to do that investment, and also buy insurance sometimes, and also all the other things. So
I just happen to be on the board of a company, and I can confirm that the boards are incredibly focused on this issue right now, for certain. Okay, we are officially out of time. Please join me in thanking our three panelists, and please send us more great papers. And now I think we have a 15-minute break. Is that right? Cool. Excellent. So 15 minutes, coffee, grab something to eat, and we'll come back and have the second panel. Thank you. Thank you, Tom.
Good afternoon, everybody. I'm Jason Healy, the head of the SEPA Cyber Program here at Columbia University in the city of New York. With the Institute of Global Politics here at Columbia SEPA, wanted to welcome you back from lunch and from those joining online. I'd like to introduce my colleague, Greg Rattray, a SEPA adjunct faculty, former CISO of JP Morgan Chase, and a longtime friend. Greg.
Thanks, Jay. Having collaborated with Jay since we sat next to each other in the Pentagon 30 years ago, and been part of SEPA for 15 years, this activity, this Cyber Risk to Financial Stability activity, is one of the types of initiatives that I've just really been happy to be a part of. I thank the opportunity for myself and Andesight. I'm the Chief Strategy Officer for Andesight. The discussion earlier about how defensive AI capabilities are an important part of the risk management mix now. Again, Jay, thanks for the opportunity for us to join in this fight together with you guys. And now I will introduce the speakers, and very thankful for them to be here. Jacob Liu is a professor of international and public affairs at SEPA. In the Biden administration, he served as the U.S. ambassador to Israel. And previously, he served as the 76th Secretary of Treasury and the White House Chief of Staff in the Obama administration. He has served in numerous additional roles in the White House and Congress, and twice as Director of the Office of Management and Budget, as well as private sector roles in Citigroup and New York University. A member of the American Academy of Arts and Sciences, the Council of Foreign Relations, and numerous other associations and national leadership positions. He has an AB from Harvard University and a JD from Georgetown University Law Center. Arvind Krishna is the Chairman, President, and Chief Executive Officer of IBM. As a business leader and technologist, he's led the building and expansion of new markets for IBM in artificial intelligence, cloud, quantum computing, and blockchain. He drove a successful $34 billion acquisition of Red Hat that defined the hybrid cloud market. And he's made numerous scientific contributions in technical fields, including wireless networking, security systems, and databases. He founded IBM's security software business and helped create the world's first commercial wireless system. He is a member of the board of directors of the New York Fed, and he serves on the board of directors of Northrop Grumman and the U.S.-India Strategic Partnership Forum. He has an undergraduate degree from the Indian Institute of Technology and a PhD from the University of Illinois. Gentlemen, looking forward to the conversation. I'm sure it'll be a great one.
Well, thank you very much, Greg, and thank you, Arvind, for being here today at Columbia. We were talking a few moments ago. I was going to point out the long history between Columbia and IBM, and came to learn that the lab that we are so proud of was the first IBM lab. It wasn't just any IBM lab. And having that lab here led to the first computer science courses being taught here. And even in recent years, the School of Engineering and Applied Sciences, the Data Science Institute, have worked closely with IBM. So this is an old and deep relationship, which we're happy to continue here today. I wanted to start by asking you a pretty open-ended question. There's so much that you know from IBM's perspective, uniquely serving so many thousands of institutions, financial institutions especially in this case. When you look across the landscape at the cyber threats that we face today, what is the overlooked risk that you think doesn't get enough attention and that the financial sector needs to pay more attention to?
Yeah, so I'll get to that answer in a minute, Jack, but I wanted to start with, it's such a pleasure to be speaking here with you with all your history of public service, not just the academic side. And it's also the coincidence that I think it was called King's College, where it educated the first Secretary of the Treasury, Alexander Hamilton. So Columbia has a rich history here on both those sides. Look, the financial industry is quite used to all the cyber threats. It's not a new topic to them. If I remember back to my first days of doing internet and cyber, the banks were the first ones to kind of wake up to all the risks and really take a lot of steps towards it. The concern becomes to the question you're asking, what is the risk I should worry about? Is it a hacker coming through the front door, so penetration testing, hardening the perimeter, the network? Is it somebody riding somebody else's coattails? Is it social engineering? Is it a client trying to commit fraud? There's a vast majority. I think, to the question you're asking, one risk actually outweighs them all, and that is somebody getting hold of a credential, and by that I mean an electronic credential, and using that to enter a system, and then creating havoc in the minutes, hopefully minutes before they're caught, because then they can leave breadcrumbs to be exploited at a later time. And so you say, oh, wait, I mean, like, if you're always protecting who's coming in the front door, but ask yourself the question, how many other things are you connected to? So could one of those credentials do this? Is it a insider's credential because for convenience you probably let them expire every few hours, or probably, unfortunately, 24 hours? So that's a big period when something could happen. Or is it something from one of these third parties who gives you a credential? I think this whole aspect of, and it's going to be that tension between, well, if I need you to authenticate every few seconds, that's going to create a lot of tension. Or is it every few minutes? Maybe there's a risk-based appetite to it, and I don't think anybody's taking sort of a nuanced view on it. Right now, it's sort of okay, I'll go to hours, and then that sort of applies across the board as a horizontal. And so this question about a credential, I think, is the understated risk in the financial system. And if I remember the stats, because to the point, we do monitor thousands of our clients, I think the current stat is 26% of all break-ins are due to a credential being, let me use the word misused. It may not be as egregious as being stolen always, but it's misused. And so at 26%, that's pretty significant. So
Yeah.
that's
and,
what I would
And I know from my government experience that some of the worst exploitation of government information has been through use of credentials.
Yes.
So it stands to reason. Can I just follow up with a question? What does IBM do with the understanding that risk to try and mitigate it?
Yeah. So I'll first begin with ourselves. So I'm a firm believer the what are called 2-factor and 3-factor authentication techniques go back 30 years ago. Actually, I think they came out of the government, probably out of a mixture of NIST and NSA as this. It always became, look, if all you're trying to do is do electronic protection, that in a sense is what you know, aka a password or a second one or a third one, or even an authenticator app to me. I mean, like, I'm sorry, those are all in the same lane. The original 2-factor, go to the English description. What you know, what you have, and what you are. So what you are is the biometric, and I got all the privacy concerns, but if the opposite side of it is that you can cause severe harm, then okay, what you are. What you have used to be in the old days a hardware token, but today it could easily be something on your device. So it could be your device, it could be an additional device, and there's a lot of techniques. The phone number, by the way, is easy to, unfortunately, clone or copy, so it should not be the phone number. But for example, I do a very simple example. Let's go at the consumer level. If you're an Apple device user, then a phone number is insufficient. It actually gets into the IMEI, and it also gets into the Apple ID. So you've got to have all of that correlated. So then there is your password or an app or a website. There is the what you have, which could be that or a one-time password coming over one of those channels, because it is tied to a few more things than just the app and the biometric. You combine all three, and I think that you're in a better shape. I would not call it perfect, Jack, just to be clear. Even that, I think, can get broken into. Then that's what we do. And I got it. Our people complain sometimes. And if you change your building, sorry, we log you out and force you to do it again. Time clock expires. I'm not going to expose on how much, and you got to do it again. You change your device, you got to do it again. So people complain. But as a consequence, I'll say we've had limited success from outsiders trying to do this. We try to insist on the same for our people who do work on our clients. I'm not going to claim we are perfect because I think we need to tighten this up a bit more. So we insist if you do work for a client, that what you have, you can only do it from some devices. So if you go home and you forget your work computer,
Trusted devices.
trusted devices. We actually put certain pieces of software on a device, and that actually also tries to watch what's happening on the device. And once in a while, you'll catch people. Look, what do you do on your own time? We are not so restrictive. You can do certain things that, whether they're moral or ethical, is your problem. But they have to remain with a certain boundary. But if you do them, we're not going to let you get into work or on any of our client systems from that device. So those are things that we do in addition, but you also put a lot of monitors to watch for unusual behavior. So that's additional. By the way, I think all our large banking clients do exactly the same. They're not doing anything less. The issue is going to become then the third parties. Yeah. So not us and the bank, but who they use and who us use. And that's where I'm cautioning myself. I am not sure that we're as good on that as we ought to be. We try to be. In our contracts, by the way, I think 4 years ago, we put in requirements. So it's there legally. All that said, I think unless we find a way to audit it, and I think the way to do it, because you get into the how much work is there, but AI tools gives you a way to actually do it now, which we couldn't do 4 years ago.
So you raised the issue of third-party risk. I know when I was at Treasury, if you asked me the rank order of my concerns on cybersecurity and financial services, third-party risk was at the top of the list. Because the largest financial institutions had pretty good systems. They were not perfect, but they were putting enormous resources into dealing with it. They brought vendors in, and it wasn't the case that they were all as carefully vetted and controlled as the base system. And then you went to medium-sized and smaller-sized banks, and the protections got less and less. Has that gotten better in the last 10 years since I had real visibility into it? I know I had a number of meetings with the most senior CEOs and COOs of financial services firms because we thought that was an issue that needed to get into the C-suite.
I actually believe, unfortunately, I think that issue is worse today than it was when you were responsible for these things as Treasury. I think the reason for this is the following. So the very large ones, whether we call it the top dozen or the top 5, they are under so much scrutiny and they're so conscious about it for their brand. I agree with you. I think they've actually gotten better. And the amount of monitoring they do, not just actual protection, is very robust. I actually think the bottom 3,000, if I think of it as 5,000 entities, including credit unions, etc., I actually think are quite good because they actually, I think, came to the conclusion they can't protect themselves. So they actually just gave up and they've outsourced it to reasonable players who, for their own brand, I always say there needs to be a commercial motivation. It's not, and the commercial motivation can be a big fine. I mean, that's also a motivation. So the bottom 3,000, I think, are pretty good. That leaves you that middle 1,000. And I do worry that then, because there's been so much over the last 10 years fear of, I can't move fast enough, so I must use this fintech to do something. And the fintech says, hey, if you need me to come transparently through your front doors, then you need to give me API access to your back-end systems. Okay, the few big ones, I'm pretty sure people like PayPal and Stripe do things pretty well, but there's 6,000 others. And somebody will say, well, I can save a dime, so let me use that one, not the big one who is unwilling to budge on their rates. So I think that sort of, I'll call it FOMO, that I'm missing out on something, because I'm not yet convinced that all of these actually are a lot of big business, is what is causing to me the concern that you've opened yourself up because you wanted to provide a convenient service, and now I got it that on paper you're saying they need to be careful. Are they really being as careful as they ought to be? I think is a clear risk. I wish that the regulators would think about doing a stress test on this. Mm-hmm. I think that post-2008, the larger banks, but more importantly, the regulators have gotten really good at counterparty risk on trades, on instruments, on loans, on credit. You take it, I got it. They don't love the stress test, but it's pretty robust because it sort of says, I don't care how good you are. I'm just going to imagine the other side goes away. Now what happens? Yeah. So that's a really good practice. Is there a way to do that on the cyber and tech stack case? I think would be a really good practice.
Yeah, and as we were talking earlier, whether it's a financial institution that's seeking to make the transaction experience easy for a client that competes in a way that lowers the standard, or controlling the cost, tries to get the penny or the nickel and lowers the standard. Is that something that the marketplace can solve on its own, or does that really require some government framework, some regulatory framework?
So you're putting me a little bit on the spot there, because at one level, I would say that for-profit companies hate regulations and generally push back against regulations of all type. And to be completely candid, the tech industry has been remarkably successful generally in pushing back against all regulation. For a reason, maybe we'll get to it, which has actually been good for the country. All that said, I do believe that in this case, a common ground, so it cannot be a ground for competition, so you make it for the sake. I mean, there is, even in the tech industry, the reason that open source exists is you need a common ground so that nobody uses that as a competitive advantage. So I think in this instance, I would actually completely subscribe to, I think, what was in your mind to say, if the regulator insists that this be a common base, then that gets rid of that. I'm going to make it 2 seconds faster for you as the basis for competitive advantage. And that would be the way to make them all say, and I would say that the regulator should insist, demonstrate that you have a certain set of standards.
Switching to something that's very much in the news today, in this last week, the news of Anthropic's release of Mythos, reports of a meeting between Treasury, Fed, and financial services, cyber and CEO level folks. What was your reaction to the news of the new Mythos system, and how are you viewing what that does to change the level of risk?
So how much time do we have? Look, at a level first of computer science, there is no new news here. I'll call it the bad guys, and definitely the nation states, have been using automated tools to figure these things out for at least 2 decades, maybe longer. So there is no news at the computer science level there. So that's the good news. Now let's put the bad news. The bad news is that before it needed an expert, using a set of tools that was pretty sophisticated, so you needed their expertise on those tools to also be there, and they would probably take, let's call it hours or days to find and create an exploit. That time scale is now seconds with these tools. And to make it clear, this is not a fiction. This is quite real. It's not unique to Mythos. Mythos is just maybe twice as good today as the other LLMs. It's not like 1,000 times as good. I got it. Our industry is wonderful at magnifying things and making them look to be manna from heaven. It's twice as good as their alternates. By the way, twice as good nowadays is about a 4-week advantage. So everybody else will get there within 4 weeks. And if we can talk about other nations, they'll get there in a few months. Because in this industry, once you know it can be done, everybody else is going to go do it. You don't even need to tell them how. All they need to know is it can be done, because that gives them the confidence to get there. All that said, this is all about the perimeter, and this is about the systems which are open to the outside in some sense. That is not the real risk, even though that's being talked about. It is a risk. You should harden them more. You need to put more monitoring. I'd say kind of got it. The techniques to sort of solve that are always going to be harden your perimeter, make sure you have no open holes. By the way, reduce your blast radius, make sure that credentials for one thing don't carry you onto another. I'd say the large guys all do that already. So they'll put more monitoring and they'll watch for it, but they're not going to actually be the ones who'll get massively exploited, probably a bit more patching and a bit more hardening. I think it goes back to the earlier question you asked. Will the third-party people, the smaller vendors who don't have that level of sophistication, will Mythos and similar tools really be the ones to help the bad guys get into them easier and then ride a trail back? I think that is the real danger on Mythos. So when people are talking about config and reverse engineering binaries, okay, I got it, but like that's a really sophisticated attack. Okay, that's a nation state level. That's probably not the average criminal or college kid trying to make a name for themselves. It really is not. But getting into a third party and then coming back, that is, I think, unfortunately, going to be a very, very real risk that amplifies with Mythos. I'm not going to say it wasn't there before. It was there before. Right. But if it becomes 100 times worse, that's significant.
So if you go from AI to quantum computing, is there a link between the two in terms of the immediacy of the risk?
I don't believe so. So for those who are not familiar with quantum, the reason the Secretary brings up quantum's been talked about as a cyber risk since it was conceived, which was like 30 years ago. And the reason for it is very simple. All of today's encryption is based on factoring very large numbers is a really hard problem. That's maybe not quite a theorem for those who do math. It's not. I know we love to call it that, but it's not. But practically, over 70 years, it's proven to be an intractable problem. Got it. That is one problem, unfortunately, provably, that larger quantum computers can solve in milliseconds. So the danger on quantum is different than the AI risk of breaking into systems. The danger on quantum is going to be, today's encryption has no value. I actually believe the biggest risk is not breaking into systems. The biggest risk is that data you thought was encrypted on a disk that you threw away can now be read by somebody, and we'll have 10,000 Panama Papers scandals. Or we'll have 10,000 scandals of, wait, your government told me this, but this was your private communication. Like, this is a complete odds. And so the level of trust will go down then because of quantum. So my advice is, given that this, some people call it Q day, is still 5, 6, 7 years away. It's not like tomorrow. Why don't you start using alternate techniques so that that danger is taken out? The AI for the next 10 years is going to help us in building quantum computers and writing quantum algorithms. AI will definitely help on that. I don't think it makes the cyber risk of quantum higher or lower. It's sort of orthogonal for some years. Then at some point it could be that AI lets you exploit a quantum computer without being a quantum expert. That is there, but that's probably still 10 years away.
And in terms of the catchphrase, harvest now, decrypt later, that's a little different than just you throw away a disk and it gets into the wrong hands. Is there
That's a real danger. I think the harvest now, what the Secretary is saying is people may listen to an encrypted communication line, just store the data, people today say, I don't care because it's encrypted, you can't do anything with it. But if you store all of it, if you store enough of it, especially if you could watch the early handshakes, the chances that you'll be decrypting this in the early part of the next decade is reasonably high. And we do know that some nation states, let's leave them nameless, have been doing this. And that is going to create embarrassment for most and real exposure for a few.
Yeah, it doesn't feel benign if large bodies of confidential encrypted data are stolen, but it does feel very different if you believe they're encrypted than if you believe that over time they'll be readable. And it puts all the more burden, I would think, on protecting access. So things like credentials and authentication. If the way you lose large bodies of data is through human error, that's would seem to be the thing that's most controllable.
Correct. Look, I think on this topic, the good news is, at least from the conversations that we have been having, the very largest, the GSIBs, to use a phrase that probably this room is very familiar with, have actually started up on serious work on this topic. I would say they're perhaps not as far along as I would love to see, but it is serious, unlike 2 or 3 years ago when they were kind of punting it down the road. So that is a good thing. I do think that that is a place, because it is painful more than it is expensive. It is expensive, but it is painful to convert. It's not technically hard, by the way. It's not at all hard. It's just painful. I think this is where actually, to your point on regulator, it would make probably a very big difference for a regulator to dictate that we're going to demand you have, for the sake of argument, I'm not a regulator, so I can say this. I'm going to demand that you have an extra couple of points of capital reserves because you might have that danger. That, believe me, that would be enough to make all of them say, I'll get it done by next year. It might help those inside the larger banks who actually want to get it done. I'm not sure that there is a real pushback that I'm seeing from those who need to get it done. It's more, do you get the envelope to get it done?
My experience as a regulator is you just had to suggest you were thinking about raising reserves, and you got a lot of attention.
Right. That may be enough, actually, in this case.
Again, to build on kind of some things that are currently in the news but have caused, I think, attention to be given to some of the issues in cyberspace. With the level of kinetic military activity around the world right now, and the physical strikes on some data centers in regional banking hubs, what do you think that tells us about systemic vulnerabilities? And I should say, as just a kind of personal note, I was involved in negotiations about trying to avoid having data localization creep in to trade agreements, because all the benefits of having a single coordinated, harmonized network start to get chipped away at. I've been wondering in the last few months, are there security issues that mitigate against that?
Yeah. So I think that the way to think about this is the analogy really comes from biology. If an organism is overly homogeneous, so if you're only local, in some sense that's homogeneous, that causes a risk. And you can go to Darwinism, or in this case you could go to, if one drone can cause a small fire. By the way, a small fire in a data center which doesn't directly touch all the computers is as devastating as a big fire. And the reason is, if you think about the couple that happened in the Middle East, a small little fire means that some sensor goes off. If a sensor goes off, water gets sprayed. Please tell me what happens to electronics if water gets sprayed. So So I think it was quite conscious and figured out. It wasn't an accident. So there is that risk. On the other hand, the same risk happens if you go to only one external provider, because something could happen there. It could be a cyber attack, it could be a physical attack, it could be badly written software.
And you have a single point of risk.
And you have a
exposure.
So all of it comes back to think about it back to those same terms of concentration risk, which is the financial term, single point of failure, which is kind of the systems way of thinking about it, to say you need to have diversified systems. Maybe not 100% of what you do, because I would react to maybe your marketing and customer acquisition sites could afford to go down for a couple of weeks, but your core systems, payments, people knowing how much money they have, all those things, they can't go down. Because if those go down even for 24 hours, you'll get panic in the system, and that's not a good thing. So I actually firmly believe we need to get to the regulators thinking about what does diversification mean. And this is perhaps more important almost outside the United States than it is inside. But outside matters to us because 2/3 of the money flows through our systems come from the outside. People don't realize this. Only about 1/3 are from the inside, and we want that strength. By the way, so I'm a technologist, but I actually think a huge part of why there is so much economic growth here is because we are the financial center. Over 70% of the money flows go through the United States system, and that's a huge advantage for us and the companies that are headquartered here. So to protect that, we need our partners on that side to also be safer, because that is, I think, the only way through this. And I think, unfortunately, now that people have learned, because of those few strikes there, this is now a weapon that is there for the next 100 years.
You can't put the genie back in the bottle.
No. When you realize that a $10,000 device can take out a $100 billion bank, it's asymmetric, and that asymmetry is real.
Yeah. So another thing that's in the news with some regularity these days is deep fakes, where finance employees are, deceived by AI-generated deep fakes, and there are transfers of large amounts of money. I remember when I was at Treasury, this is already a long time ago, I was shown the pictures of the real and the fake, and I would have been hard-pressed to have known which was which. And I suspect that that's gotten harder, not easier. What are the defenses against this, challenge, which is pervasive, not just the financial industry, but particularly in the financial industry? And do you think there's a potential systemic risk that presents?
So I think the good news is, I think the largest institutions at least have taken a lot of steps to protect themselves, at least for large dollar sums. So let's put some color around it first. So I said, hey, biometrics is a great piece to protect yourself in the beginning. But if biometric can be a voice print, and I would tell you straightforwardly that faking a voice print is now unfortunately rather easy, unless you're very sophisticated. But voice print is very easy. It can be done with a couple of dollars. Okay, that's a problem. If you're depending upon somebody who looks like somebody on the other end of a video link, that's unfortunately very trivial to do. In person is harder. Putting aside all the Tom Cruise movies, in person is a lot harder. But over a video link, it's not so hard. So this is going to happen. I think on the consumer side, it comes down to what protocols do we want to set up, that it's not enough to have only one or two channels. You need to have multiple, going back to this thing. I think on the large enterprise side, people are going to insist upon things like 4 eyes, meaning at least 2 people on the other side. But if it's just voice or a video, that again is easy. It's no harder to do 2 voices than 1.
If you're using a machine to copy. Yeah.
Machines are unfortunately rather scalable. So it comes down to, again, you've got to protect yourself by having back to, it's not just what your voice print is. So which biometric is actually not easy. I think, at least to my knowledge right now, iris scans and fingerprints are still not easy. I'm not going to say they're impossible, but they're not easy. And so those become, but it's not, facial recognition, if it's across the screen, is easy. In person is harder, as I said. Mm-hmm. And facial recognition also is not just one. The simple ones look at 6, 7 points and you're done. The more sophisticated ones begin to look at 30 or 40 points, and they also insist upon 2, 3 sides. And so we're going to begin to need things like that. But the deep fake, and especially if you look at consumer fraud and the elderly population, is going to be a serious issue. And I think this comes down to education more than anything else.
And obviously, it's a huge issue, whether it's a large transaction from a business or an elderly person whose life savings are stolen. Does it become a systemic problem if you don't get your hands around it?
I think for the large institutions, because there was a friend of mine who decided to showcase this on stage, where he got a panicked call from his CFO saying, could you call up the Treasury Department and approve this, because we have this acquisition happening tomorrow morning and we need to send the wire transfer, otherwise our news is going to get pulled back at 7:30 in the morning and that'll impact our stock. So you can make a pretty convincing narrative, and I can't do it because my computer just got destroyed, and so I can't do it, I need you to do it. And he played it out for a good 4 or 5 minutes. It's not like a simple 10-second voice message. So you begin to say, in that case, what do you do? And if you call the person back, actually it's that same fake entity responding. So this is quite real. So you have to get into now, what are we going to do on those things? I think corporations, at least the larger ones, have understood this can happen and are putting steps around it. I think, unfortunately, in the consumer side, it is a systemic risk, and that's why I got back to education.
Yeah.
And what are we going to do? Education won't take it away, but if we can reduce it by 90%, now you can begin to tackle it.
I mean, this may not be a best practice, but I personally do not respond to any incoming emails from any institution. I only deal with them if I can reach out to them through a known source. I probably miss some messages that have content that I would be better off having.
Look, I'll give you my practice. If I get an email or a message saying to reach out, first of all, it's also important not to use any of the contact information in that, because that is, again, the other way that they'll get to you. You should find that from an alternate source and get back, especially if it's a financial institution, as opposed to listening to their text message, email, phone call. My answer is always, I'm going to go find it from what I already have and call them back and get routed. It may be more inconvenient until I can get to, did this actually happen? And here's the reality. It's half and half. Half the time you get something, it actually is authentic.
Yeah.
And the other half, it's not.
I had an experience once where I got a call from somebody I didn't know at my bank saying there was somebody presenting a check on my account and wanted me to take an action. I said, I don't know who you are. They hung up and they got a banker I knew to call me because it was real. There was somebody trying to kind of hack into my accounts. Not hack in,
You're right.
Get a check. But you get so suspicious that sometimes you could miss the moment of protecting yourself. So it's a delicate balance.
It is. Unfortunately, what you're describing would work for 1% of the population. 1% probably has a banker or somebody on the other side that they know by name and a phone number and.
Right.
But 99%, that's not going to work. So it comes down to, what do we teach them to do?
Yes.
That would protect them. And I do think that is going to be. Look, 50 years ago, these were not problems because the only way you moved money was you walked into a local bank branch. You probably knew the teller on the other side.
Yeah.
They knew you. So if somebody tried to get into your account, it was not going to happen.
So we're getting close to the end of this conversation. If I could kind of close with a broad question. If there's kind of one thing, one policy change, one industry commitment, one investment, one thing that you think would really strengthen the financial sector's resilience against cyber risk over the next period of time, what do you think that would be?
Look, I think first, to be completely fair, I wish there was a silver bullet, so let me just first phrase it, but I will answer your question. There probably isn't. It's a collection. My true answer is, I think layered defenses is the best possible answer. And by layered defenses, there was a cartoon in the New Yorker. This must have been 99 or 2000. It showed an igloo with a polar bear on the outside punching his fist through the outside, and the Eskimo inside about to get eaten. And the cartoon was crunchy on the outside, yummy on the inside. So, look, that's my serious answer for pushing on layered defenses. People can break in, they only get a little piece. If they break through that, they only get even a smaller piece. That's what layered means. On the other side, I'll go back to my beginning. How do we make sure that credentials or identities are really confined to their purpose? The industry term for this is zero trust.
Right.
By the way, but in zero trust, if you then say that once you're in for everything and it's a 24-hour, that's not zero trust. Zero trust literally means that every interaction,
Right.
you're trying to verify who's on the other end of that interaction. And I think, unfortunately, I think that's where we are headed.
And even if there's friction,
Even if there's
in a world where the
friction,
goal is to eliminate friction.
on the
you
machine-to-machine one, it becomes cost, not so much friction. On the human-to-machine, it becomes friction. But I think true zero trust is where we're headed, because that is the ultimate layered defense.
And unfortunately, that goes against some of our character, which is to try and just make all these things immediate, automatic, and easy.
That is human nature. Human nature will always
yeah.
find the easier answer.
So I think we have a few minutes for questions. Is that correct, Jay?
You had till 45, so we're kind of at time.
Oh, we're at time. Okay. I saw some microphones in the back. That was why I looked to you. Do you have time for one or two questions?
Sure.
Why don't we take two questions and then give Arvind a chance to answer both? Over there and over there. Go ahead. Yeah.
You mentioned quantum computing and how that's maybe accelerating over time. Do you see that transition? You mentioned it's possible, but is that maybe going to compete in technology budgets with things like AI?
Look, as I think the world has woken up to, the AI budget is going to come from many other things. I'm actually not convinced it comes from other technology only, though some of it will. Something that I've said in other forums, not here. What happens if I tell you that technology knit whole, so all of today's plus AI plus quantum, is more important than your balance sheet? Then you would have a different perspective on what should that budget be. I actually think that most nations have woken up to that technology, I kind of put it as three. Defense was always important. A robust financial industry was number two right after that. And that actually here goes back 200 years. Defense, we can say, goes back 300 years. And I think in the last 50 years, two nations have woken up to technology is as important as those two, the United States and China. I think others are actually in that process of waking up because you hear it now everywhere. So I think that it'll be a little bit from the other two, but it'll actually come from other things. Because if using it lets you make a better pharmaceutical and compete, then it's actually from your R&D or acquisition budget as opposed to the AI budget, if that makes sense.
All right, one more over here.
Oh, sure. Thanks, Professor Liu, and thank you, Mr. Krishna. A lot of talk these days about how AI is changing the nature of the economy. For example, more physical manufacturing type work. Still early days. We'll have to see where that goes. But when you think about these kinds of predictions, how do you see security changing? What are things that come to mind?
Look, the change in the economy, I think, is both going to be more dramatic than people think about, but also less. I think actually a lot of the physical economy is not going to change that much. It'll become more productive. Robotics certainly is going to have a big play. But the 60% of the economy that is roughly physical will get productivity, but I don't think it's going to dramatically change. The other 40% that is white collar, I could actually easily see half of it change pretty dramatically. And the reason it gets so much excitement from the media and from everybody is because all the people pontificating on it are white collar, not blue collar. So that's the one part. On the pure security side, look, if all exploits to the point, I mean, Jack mentioned deep fakes, we talked about credentials, you can talk about finding easier penetrations. This is just back to the same element of physical security we always talked about. Who was the guy who a long time said, like, why do you rob banks? Well, that's where the money is. So
Willie Sutton.
So, like, are we going to use AI to try to break into things? Of course, because it's there, it's a tool.
It's where the money is.
It's where the money is. So I think we just got to be prepared for that. It's just going to happen. It's hard to predict because I think that clever bad guys are remarkably clever at figuring out ways to use things that the good guys never thought about until they got done, and then they had to protect against them. So I think that trying to predict how they will use it, I don't think is appropriate. That's why I go back to always layered defenses. Assume they're going to break in. How can you keep them in the smallest compartment possible?
Well, thank you very much, Arvind, for a really interesting conversation. And please join me in thanking Arvind Krishna for being with us today.
Thank you. Thank you.
All right. Hi, my name is Jordan Halpern, and I'm a first year here at Columbia SIPA and the president of Digital and Cyber Group. We are now going to take a quick 10-minute break. Please report back here at 1 p.m. for the next panel. Thank you very much.
The program will begin shortly. Please find your seats.
Lift the mic a little bit. Good afternoon, everyone. I'm Alex Wortman, 2018 SEPA alum, and it's great to be back at this conference. This event holds personal significance for me. During my final semester at SEPA, I had the privilege of co-authoring one of the papers developed on the project of cyber risk to financial stability, work that directly launched my career into cybersecurity. Combined with my capstone, it really helped me transition from journalism into the field. I went from working in a Big Four consultancy to a multinational law firm, and eventually to the Federal Reserve Bank of New York, where I serve as a cyber and IT supervising examiner focused on third-party risk, specifically critical service providers supporting financial institutions. A sincere thanks to Trish and Jay for continuing to foster this work and to bring together such important voices across the public and private sector. It is now my pleasure to introduce our final panel, What's Next, moderated by Jay Healy.
Amazing. Thank you so much. And thanks, Alex. It's great to see our alumni going out and doing great things and continuing to knit that tight web that we've got with the with the New York Fed, as well as just across the city where we've got people that are building out banks' cyber threat intelligence teams, bank cyber exercise teams, and that are just looking at risk. So what a great day. Thank you very much. So we've heard from great panelists about what are we learning about cyber risk to financial stability. Some really great things. We heard from the second panel how we're doing exercise, how we're mitigating that risk. We had a fabulous spotlight interview where they just talked through a lot of different areas about how this technology is playing out. And so now we're going to look at what's next. And to a substantial degree, we're going to be picking up from some of those elements that Jack and Arvind had talked about with three fabulous panelists. To my right, Greg Rattray, whom you already met, had been the CISO for JP Morgan Chase. We worked together at the Pentagon, worked together at the White House. He's adjunct faculty here, helps run the Next Peak cyber risk consultancy, also the chief risk and strategy officer for Andesite. Marina Kaganovich has a great background in compliance and finance controls and risk, and is now with the Office of the Chief Information Security Officer for Google Cloud. Neil Pollard, another longtime friend, who has done quite a lot when you're looking at cyber risk and controls, including the Chief Information Security Officer for UBS, and now running the practice out of control risks. And maybe you can talk about control risks, just add that into your answers there. Also a great background in the US government. So Marina, I kind of really want to start with you because, boy, AI is just featured in every one of the panels we've heard today. It was the spotlight of the spotlight interview that we just heard. It's accelerating technology's rapid evolution. And so we heard a little bit about this, but can you expand on what we heard in the previous panels and with Jack and Arvind on how financial services institution these and how we can look at areas like human in the loop to help control these risks? Thanks.
Yeah, absolutely. Is this on? Everybody can hear me? Hi, everybody. And Jay, I just want to actually start by saying thank you again for including me in this fantastic panel. It's actually my pleasure to come back. I think we did this a year or two ago together, so very nice to be back and to see some familiar and friendly faces in the audience. I think you'll probably hear, at least from my perspective, echoing a lot of the points that were made in the prior panel. I think that the change that we're living through is really showing us that we as a society, we as humans, we as financial services organizations, however you define the we all need to get comfortable and adapt to a much, much faster pace of change than we were previously used to. And I think with that change, particularly from a cybersecurity perspective, translates into anticipating a much higher velocity of cyber attacks and attacks that are more sophisticated than we would previously experience, but particularly at that velocity. And it's one of the things that really highlights the defender's dilemma. Many of you might already be familiar with it. If not, I would suggest that you search for it. Google published a paper on it a while ago, but the general concept is that bad actors only need to get through once, as opposed to the good actors and the defenders need to be perfect all of the time in order to protect their enterprises. And so I think what that asymmetry really often causes folks to panic or to kind of have this analysis paralysis occur as they're looking at all of the threats and trying to figure out what the next steps are. And I think with the emerging tech that we actually have a tremendous and very powerful weapon that we can use as a proactive and a disciplined response to the attacks that we must anticipate. They're definitely coming. So, rather than sort of being scared and having our heads in the sand, we really need to take proactive steps. And I think a lot of those steps, we've been seeing a lot in the media over the last couple of years that there's various novel attack paths that are anticipated with the use of AI. But it's also really, really important to kind of lock down and have a good cyber hygiene for the sort of more fundamental things, the sort of back to basics approach. And I think it was something that was brought up in the last panel as well, but I would echo here that we need to make sure that we're investing sufficient time in those fundamentals. The zero trust aspect that was mentioned previously, if done right, that significantly manages the blast radius of an attack, right? It requires authentication, authorization, it requires toll gates. It's a very effective defense that organizations should consider. It goes well beyond just perimeter defenses. Also, IAM and other aspects I would mention as well.
And just to build on, I didn't mean to interrupt you because I hope you continue on with your points. But it was interesting in how much, to tie what you were saying with what Arvin was saying, like layered defense and controlling your credentials, right? That's like that's very basic advice. Although the way you're talking about, the way he talked about it, was, well, this is very much a very forward-looking way of doing this, but we just have to do it with more discipline. Is that fair?
Well, I'm going to plug Google here because we actually pioneered the concept. So there's quite a bit of literature available on this topic, and it's something that we've implemented on our platforms as well. But I think it's, every organization is going to function slightly differently, but the concept remains sound. And I think that lots of folks often look at it and don't necessarily dig as deep as they need to in terms of implementing it, which is why I say that zero trust, is not the equivalent of perimeter defense. And to build on the points from the earlier panel, I think it's something that I hope folks will walk away with as a potential next step to, to bring back to their organizations. The other aspects that are sort of back to basic concepts, right, is really evaluating identity and access management, vulnerability management, patch management, BCDR planning. All of these points were mentioned in the earlier panel, and I think are often perhaps overlooked or if not overlooked, just not as focused on, because with the emerging capabilities of AI, there's just so much interest in terms of the novel concepts that sometimes we forget that some of the fundamentals are ones where we might be weak as well.
Greg, can you build on that, and then maybe Neil following after that?
Definitely. I'm going to stay a little.
Could you use your handheld mic, please? Yep, it's good.
On the meaning of the the recent sort of focus on the speed at which AI empowers both offense, and again there was some good remarks about it needing to be used on the defensive side. It seems like the last 2 weeks, this is like 4 times a day discussion at every level, from enterprise defenders to governments. I was on a collaborative call with large American financial institutions and the 3 Japanese G-SIBs last night, right? And we were talking about the agenda for our meeting that we're going to have in Tokyo.
Can you just
GSIB is a globally systemically important bank. JP Morgan's a GSIB, is 8 American. UBS is a GSIB. So I don't know, Neil, the number around the globe. There's 8 American. Yeah, 8 American, three Japanese. So they brought that topic forward. That's what they wanted to hear, that the American banks would talk to them about, is what does all these recent developments at the corporate board level. Again, it was mentioned that the Secretary of Treasury brought the CEOs together to talk about this. One conversation sticks in my mind that was early, a couple weeks ago in Washington, D.C., the Aspen Cyber Group. And these are people who've led NSA, are CISOs, and the notion that was just mentioned that basically this means we're going to have our vulnerabilities completely exposed, and this was referred to as a cleansing forest fire, right? By somebody. It's also Chatham House rules there, so I can't name the individual, but a person who held one of the highest national cybersecurity positions. And that dialogue took for a while, and there was a lot of positive head nodding, like everybody better get serious about vulnerability management. I will tell you, I reacted pretty viscerally to that. And then a couple of the other people who also serve in consulting roles or work with a lot of enterprises, we can't secure these tech stacks. The notion that, highly advanced firms that can take advantage of modern technology, but so much of our, organizations have so much technology debt, and, the transformation it'll take to get to a securable infrastructure is going to be very difficult for most. And sort of, I think it's a hopeful but potentially self-delusional notion that we can sort of hygiene our way out of this risk that is coming our way fast. Where the term that didn't get used, much today, I really liked the notion of, he called it layer defense or segmentation, and reducing the blast radius, and the extent to which you can get zero trust in place, that's all good. But resiliency more broadly, and being able to get off the mat when you get punched. We are going to have punches that we don't see coming. Some of those are going to be near knockout punches. And if you can't get back up off of that, and a little bit to the segue to geopolitics, having spent the last 4 years with some of the major American technology and cyber companies, including Google, Mandiant, helping the Ukrainians, I am always able to talk to the Ukrainians when I need to get a network connection. They have been amazingly resilient and they don't have good hygiene in their networks. I'll guarantee they're on old tech stacks that have a lot of holes, and the Russians can get at them. The Ukrainians know how to keep their tech running under that pressure. We need to learn the lessons of resiliency, and we need to focus more of our energy on that get off the mat motion than the hands in front of your face motion. We need both, but yep.
Yeah, a couple of things there before to get Neil's comments. So one, when you're talking about some of that reminds me of the second panel, what we're hearing from the clearinghouse about how they've been using internally, and it's great to hear about the resilience exercises that are coming in. Maybe we talk about that. But to tie it to something, the first thing that Marina said that really caught my attention when she said we've got to deal with this faster pace of change. Because the book that got Greg and I into the field, we were both U.S. Air Force intelligence officers, and we both decided we wanted to go in this path because of a book by William and Heidi Toffler that had said it's the accelerating pace of technological change is going to affect us all as a profound psychological shock. We're going to feel like strangers in our own society as we see as some people will see their civilization accelerate away from them because of this accelerating pace of technological change. That basic idea came from 1970. And so here we are, and every time we hear one of these new ones and say, well, this has happened before, we've dealt with this before. This is common to how it is handled before, like mis and disinformation. Arvind started it this way, right, when he said, the basic computer science here hasn't changed. We've dealt with this before. But it's that everything is not just moving, but it's this accelerating pace. And so now on top of all of the other accelerating pace of changes we haven't still dealt with, now we're going to have the AI on top of that and maybe quantum. Neil, do you want to, anything else on AI that you'd like to pick up?
Yeah, I can continue on the AI theme to address something you want me to talk to about convergence, but I do also want to echo.
Get to that,
yeah, we'll get to that in a second. But I do also want to echo something that Marina, excuse me, and Greg said too, which is I do think, and I agree also with. I mean, far be it from me to disagree with the CEO and chairman of IBM, but his point I think was valid that we have seen this conceptually. It's not new. It may be a step function increase in velocity and power, but what I also had a visceral reaction as I saw the cleansing fire, having grown up in Oklahoma and seen plenty of cleansing fires that still knock over a bunch of oil wells. There is a benefit that will come at this. The metrics will all change. Everyone's going to have a whole stack of vulnerabilities they're going to have to deal with. But and I'd welcome Greg's perspective on this. When you look at chief information security officers, a lot of them have come from engineering backgrounds. I was a little bit different. I have been an engineer, but I'm from an operational background. I was an intelligence officer. Greg was an Air Force officer. And I'm assuming, I think I know Greg well enough to know he brought an operational perspective to the role of CISO. And what I mean by that is engineers spend their time every day thinking how to make something perfect, how to make something work smoothly. I spent my previous career trying to think through how to break things. Like I would look at a system and think, how can I screw that up? That changes your priorities on where do I put this extra dollar I just found? What do I spend this dollar on today? And I think that what happened with Mythos and the drama that's created will cause a reckoning in the economics of cybersecurity and the economics of resilience in that people will be spending, rather than spend this extra dollar I have on trying to prevent something from happening, I'm going to acknowledge that something bad's going to happen, that this foolproof system, some fool is going to walk through that door and unproof it. And I'm going to spend this on recovery. I'm going to spend this on an ability to better manage consequences so they don't spiral out of control. I'm going to spend this on an improvement on our ability to work under degraded conditions and dispense with the false notion that I will be able to improve the conditions. And I think that will ultimately be a good thing, and it will have a more operational mentality to a lot of budget planners thinking, okay, this is going to fail at some point. How can I work through the failure and manage it? So I think that is, and AI is going to have those types of moments, not just as a tool that will cause this reckoning, but reckoning AI itself. And what is its role in the digitalization strategy of my corporation, any corporation? Digitalization will continue. World Economic Forum estimates it will contribute to 70% of new economic value creation, and digitalization will play a square part of that, unless there's an AI event like 3 Mile Island, which everyone was saying the same thing about nuclear power in the early 70s, until that dramatic moment happened and totally changed the trajectory of nuclear power adoption. If you have something like that in AI, then it will totally change the trajectory of AI adoption.
Yeah, that's great. Although nuclear power is big and complex, whereas AI, you can still have these models. Like you didn't have to worry about small players doing nuclear, whereas you have to small players doing AI. I loved your example though about not going for the perfection of the engineer, but going for the resilience of the operational planner and the crisis manager. And we're here at Columbia, so to me, it's very political psychology, right? Where do you come down versus like Locke, Rousseau, Burke? Like, is the purpose of your politics is to try and achieve heaven here on earth and like have the perfect society, or are you just trying to avoid hell? And like just trying to keep the humans from being the worst to each other, or do you really want us to lift us up so that we're all our absolute best selves? And so we need to be doubling down on the avoiding hell. Maria?
Can I build on that a little? I completely agree. I mean, just generally speaking, don't let the perfect get in the way of the good. But I think with the increased sophistication and the velocity that we're talking about, I think to build actually on some of Neil's points, I don't see reasonably where humans will be able to handle that work without using AI in support of defensive functionality as well. Because I think thus far we've been talking about it as the attack path, right? And sort of having more traditional cyber defenses applied to it. But with that type of volume and that type of velocity, it looks like we're in a situation where we're really going to have to lean on AI defending against AI. And I think that presents a whole new slew of considerations for workforce management and resourcing and budgeting and all the other pieces that we talked about.
I would totally agree with that. Just on the frontline defense, i.e., don't get punched, right? Like you're going to need AI to put your gloves up. Again, I also think AI is going to be important in the resiliency, like figuring out which things to fix first, right? Understanding, linking your business and your operations to your technology stack. Like that's a very complex problem. We're going to need to use AI for it. Something that I also sort of advocated to that group I was discussing is what we really need to watch out for is an adversary that actually is using AI for targeting, like picking critical nodes. The vulnerability part, as was discussed, like maybe Mythos is a 2-time faster vulnerability discoverer than existing technology. Again, if you use the Ukraine example or other analysis that I've done, my dissertation was on analogizing, the bombing campaigns in World War II and not realizing the elegant doctrinal thoughts before World War II. It's a lot messier, and it was messy because we couldn't figure out what to bomb well. Well, when we see adversaries that figure out how to tweak the critical nodes inside our technology infrastructure, that there's a technology that underpins the payment system. The ARC was in part started in 2016 to help to collaborate with the U.S. intelligence community to watch if adversaries were going after the things that were crown jewels and that they were sophisticated enough to know what to hit. When we start to see AI help adversaries do things that are highly disruptive, because if you watch most cyber attacks, they're kind of like throwing hand grenades. They're not sniper bullets, right, at the systemic level, right? So I think that's something that we really need to be attentive to.
Yep. And it's interesting, yeah, because to add to the Mythos, right? Mythos, from what we've heard, is good for vulnerability discovery and patching. But put that, look at the MITRE ATT&CK framework, look at NIST cybersecurity framework. Well, you've got a whole lot of other areas that AI has to do well. And from what we've heard, Mythos is 2 times good at the vulnerabilities, but there's still other AI that can handle those other areas, like the targeting, like the reconnaissance, like the lateral movement, staying, avoiding detection and execution. Okay, all right, that was fabulous. Okay, Greg, let's come back to you because it's come up a bit on geopolitics today. So certainly as we're looking forward, right, that's what this panel is. The second panel talked about just how they've seen the change in threat profile over the last 6 weeks because of the war with Iran. The last panel the fireside interview really didn't touch on it as much. They did talk about attacks on data centers popping up. But so if you can broaden out the picture, like paint us the larger landscape of what we ought to be thinking about when we're thinking about geopolitics and cybersecurity.
Thanks, Jay. What's come to mind, is I'm always usually confident my voice is loud enough without a mic. Okay. Oh, fair enough. So for all of you online, I wrote a dissertation in the 90s about the future of cyber warfare, and was it going to be similar to the 20s and the 30s, and what would we see? Actually, air warfare advanced between World War II and World War I and World War II, 30-year period, less than 30-year period, much faster than cyber warfare advanced between the 90s, when I said we were like in the 20s in air warfare, and now we're in the 2020s, right? So there's understanding why that's the case is, I think, pretty interesting. I thought in the 90s we'd be into strategic attacks and highly disruptive critical infrastructure events, and 15, it's all written down, so my incorrect answer is on the record, right? I thought we would have more geopolitical use of cyber attacks, faster in the disruptive way than it's turned out. The notion that the Chinese espionage campaign against the United States was termed by the Cyber Command commander as the greatest wealth loss, the greatest wealth transfer in human history, was something that I didn't anticipate, and is an element of this geopolitical competition. Again, there's defense secrets there, but it was very much our economic and economic competitiveness we had. I actually was an expert in a trade secrets case involving 2 Chinese companies very recently, around these sorts of things. So then, and it's a little non-cyber, but I'm going to get back to where my worry is going forward. The involvement of nation states in elections, particularly the Russian involvement in the 2016 election, that may have been a tipping point. We'll never know, how that was a very close election. There was clearly engagement by a nation state. There are elections recently. The Romanians basically did not recently allow our election to, the results of an election to proceed because of worries of election engineering. To me, that was a strategic surprise. We cyber people didn't see how cyberspace was going to be used in a way that did have, geopolitical competition consequences. So while I've been sort of happy as a defender that we really haven't seen disruptive attacks emerge as fully as I thought they might, though I think that's coming. I think with the Mythos, I think defenders are already on a slippery slope, and we may get a sort of unexpected punch that gets through our cyber defenses. Even more, and Trish, when you talked about, you brought in the speed of, Silicon Valley Bank failure, the number of very fast key elements of how we use technology, can we protect it, and how it links to either government services or business, it is going to be very difficult to anticipate some strategic surprises. 9/11, no one ever thought terrorists would put people in airplanes and fly them into buildings. We are going to see those sorts of things happen, and I think the probability of those things is rising as we go forward, with the fact that norms in the geopolitical world, particularly in cyber, but I mean in general, the gloves are off. So you don't see a ton of self-discipline in the terms of nation states being willing to not use things just because they'd be outside an international system that would punish them as a whole. I think we're going to see people seek to use. I was in Prague a couple weeks ago watching the Europeans react to the hybrid warfare campaigns that have spread across all of Western Europe. These are new times, and they're not going to be easy times in terms of having to be ready for a lot of different types of strategic surprises.
Yeah, I ran into a quote from Graham Allison in Foreign Affairs. Graham Allison from Harvard, I assume you had some classes, where he had a quote that basically the period since the end of World War II, the 80 years since the end of World War II, was the longest time where major states didn't fight each other since the Roman Empire. Right? This has been an astounding period of peace. And the period since the end of the Cold War, a tremendous drop in the amount of cross-border violence, right? States generally didn't invade each other for territorial gain. Of course, there's cross-border deaths and horrible fights with inside countries and civil wars and civil strife, but sometimes it's difficult to sit back and just say what an amazing period that was. And so the fact that we didn't see what Greg wrote about in the 90s, these large-scale cross-border attacks that were causing death and destruction, it might be that has nothing to do with the cyber capabilities. That was just an inherited characteristic of how states were behaving. And now that we are seeing cross-border invasions for territorial gain, we're seeing nuclear threats from the United States that almost don't even get remarked on. We might expect more crises, more militarized crises, states to take more risk-taking. All guns on deck, I think Bob Jervis and I called it, right, where they say, hey, we're having these crises, we'll use cyber in ways that we hadn't. That could be really dangerous. And so, Neil, I know, so maybe you can say just a touch about what control risk does and how you're thinking about the cyber physical and how this might play out.
Sure. So a little bit about the company I work for, Control Risks, to give the context of converged threats. It's a 50-year-old British consulting company that got its start rescuing oil executives who were kidnapped by Colombian rebels in the Colombian jungle. Not what I do, nor have I ever done. Yeah.
Do you mean kidnap or do you mean rescue?
Yes, both. But they take a converged look, which is their perspective is there are bad people out there that want to do bad things to good companies and good people. and they won't respect your organizational chart. They will come at you however they can. And they will use cyber means, physical means, regulatory pressure if it's a nation state. They will use any sort of lever to get what it is they're after that you have. And increasingly, that will include cyber, because AI and for many other reasons, the bar for average mob family in the Bronx to use AI effectively is much lower, and it's cheaper, and you don't have to be an expert to do it. So we believe as a company that it's important to understand what the first question is, which is who's trying to do bad things to us and how are they going to come at us? And then how do we organize to defend against that? Now, when you look at what the hybrid threats are, or converged threats, however you want to characterize it, the converged threats that bring converged risks to your doorstep, we talked about some of them earlier today on the panel, which is the insider threat. Insider will use a combination of physical access and digital access, logical access, to do bad things. Whether the bad things are sabotage, steal, IP theft, move money, whatever it is. We see cyber criminals using physical access. What was that? 10 years ago, when Lazarus Group is a cyber group associated with the North Korean government for espionage, but also good old-fashioned theft, because the North Korean regime needs to raise hard currency. And I think it was about 10 years ago they went to town on Bank of Bangladesh, and there were several banks worldwide that they attacked. The Bank of Bangladesh was the one that was reported most publicly, and managed to steal. They almost stole $1 billion. They managed to get away with. There's still about $120 million from Bangladesh Bank, central bank, that is gone forever. And they use a combination of physical and logical means to do that. They had some physical access, it seems. They had access to CCTV cameras, so they could see what a pattern of life looked for someone making a validation of a wire transfer. And then they had logical access through the SWIFT system, the Society of Worldwide International Financial Telecommunications, which is how banks move money from point to point. So that was a converged approach to steal money. And to add one more converged nation-state angle to that, the actual tools the North Korean regime got to execute that attack, they traded from Iran in exchange for missiles, as Shane Harris has reported relatively recently. So that's an example. Third party is an example. Third party providers have physical and logical access to your infrastructure, have physical and logical access to your client data. And they have people too, and sometimes people are bad. And to extend your controls over that presents a number of problems. And as I said, even if you're just a mobster running guns or running drugs, now you can use AI to extract whatever it is you want from either the authorities or from rivals or just from the typical targets that you think about every day. Now, this really presents two problems, and I'll keep going back to AI, not only as an enabler, but as a source of the problem. One is the actual risk and how organizations just deal with risk and plan against it. I was the chief information security officer. My job was not to make sure that ATMs didn't get hijacked by pulling them out of the ground and throwing them in the back of a pickup. My job was to protect the logical perspective of the bank. Others people's job were to make sure there were pretty solid locks in the vault doors holding all the gold bullion. That was not my job. Okay, and that's fine, because that's my background, and physical security, that was his background. But when you look at, and AI is a perfect example, whether the governance of a risk or these problems span multiple domains: data governance, vendor and supply chain risk, cybersecurity, infrastructure operations, regulatory, legal, geopolitical strategy, which Greg's touched on, workforce oversight, enterprise resilience. No one person in an organization is responsible for that. Look at the risk that's being posed by AI now. Computational power at scale is now becoming a permissioned resource, either because there's a New York Times article, I think it was last week, maybe 2 weeks ago, that said that frontier AI providers are having challenges servicing the demand with power, electricity. And they are now starting to ration certain customers, and certain customers are getting ticked off because their power is being rationed. The power of the computation is being rationed because the energy is being rationed. Access to power, water, supply chains, yes, advanced chips, but also supply chain including talent for coding, for developing models, choke points, undersea cables, and satellites. These are all absolutely critical for frontier AI, and these are all increasingly governed by geopolitics, regulation, and other artificial markets. So I'm a board director. I want to hear what's the AI risk. Now I've got a parade of chief something officers coming in. Well, here's the cyber risk. Here's the physical risk. Here's the geopolitical risk. Here's the regulatory risk. Back up. What's the risk?
Are banks a little better off because or companies that have a chief risk officer?
So companies that have a chief risk officer, I don't see that, especially in banks, as the function of chief risk officer. The chief risk officer is say, you tell me what your standards are to deal with all this, and I'll make sure you're doing that. As opposed to, how safe are we from some regulator or some crazy nation-state leader suddenly deciding to cut off our supply of chips, or our supply of power, our supply of water, or our supply of talent? A chief risk officer will not be able to answer that question. And from a chip perspective, maybe the vendor manager would. From a talent perspective, maybe the HR person would. But in terms of what are we doing to assure that? What are we doing to deal with the challenge of permission to compute? That is, most companies I can think of, that I know of, do not have a centralized view to that. So from a risk management perspective and setting and understanding what your exposures are, what your vulnerabilities, it's a complex question. But more to the point, we've talked about a lot about how much value creation AI is expected to contribute to. Okay, who's doing the math? It's going to cost a certain amount to assure talent. It's going to cost a certain amount to lobby and make sure regulatory winds are blowing in our favor over here. It's going to cost a certain amount to lock down our data centers physically and from a cyber perspective. It's going to cost a certain amount to assure redundant backups for power and water. How much does all of that cost? Total cost of ownership of AI risk. Who's got that figure? CISO can tell me the cyber side. Chief security officer can tell me who's got the figure. That's going to be X millions of dollars, and we're expecting Y millions of dollars of value creation from AI. Has anyone done the math to make sure that Y is greater than X?
Yep, great. Okay, I'll just see if anyone wants to add on to that. If not, let's start on. Greg, you want to start, and then we'll start getting my attention for questions.
Just a real quick one, Neil. Like what I'm seeing mostly out in the corporate world on AI risk management is governance structures that are a committee, right? And they're led by different people. I know CISOs that lead those. Sometimes chief data officers lead those. But like as you point out, the loci of risk is multiple inside of of an institution. But I think that's mostly risk identification. It's not cost of risk management, right? So I think they're still largely at the stage of saying all these bad things could happen. I've got some authority to mitigate those, but no one's adding up a bill for the chief financial officer or the appropriate investment committee for investing in AI risk management. I think it's coming. I mean, and there's this AI area, the notion of do you need a singular corporate officer to manage either AI itself or AI risk, I think but at least what I observe out there right now.
Yeah. Okay, I see Jonathan here, and I see over here.
Oh, you're holding. Okay. Okay. Thank you for the panel discussion. So I have a question, which is kind of a provocation potentially. What if the way that we've been talking about cyber is at the end of its time? So taking Greg's example of our friend who mentioned the forest fire analogy. So what if this AI allows attacks to kind of burn hot and fast over the next 2 to 5 years? What's the cyber world look like after that date? Is it something where we're no longer talking about vulnerabilities anymore in code? We're no longer talking about this as an engineering problem, but a human problem, and that some of these examples of the election, that's election interference, that's really the new type of threat, where the vulnerability is us rather than our systems. In that world, some of the strategies that we have really just near-term solutions and not long-term solutions, and some of these operational resilience plans that we have that rely on us as humans might actually become the new vulnerability.
I'll go. Like Jonathan was in the room when that whole forest fire thing was brought up a couple of weeks ago. And hopefully it's not going to result in nuclear winter instead of a cleansing forest fire where the north rim of the Grand Canyon regrows. I think will regrow because of resilience. So I've started to talk more about digital resilience than cybersecurity, and I'm branded as a cybersecurity guy because of all the things, Jonathan, you just said. Is that all these things are, as Arvind and said, and we will continue to need to do the good things that we know through the NIST cyber framework. There needs to index a little bit more on good muscle motions around recovery and response and recovery. So it's not sort of replacing all the things we have been doing with a new solution. It's going to have to build out into more human-based, more, again, behavioral things to protect ourselves, but even more importantly, the ability to fight through or recover from disruptive sort of activities. There are lessons to be learned. I'll just repeat because I'm going to personally be focused on trying to draw some of the lessons from the Ukraine into our dialogue, but it needs to be a resilience dialogue more than a cybersecurity dialogue going forward. That's my perspective.
Can I just quickly add to that? I would echo that, so in Google terms, +1. And I would also say that we need to look at it from various perspectives, right? This isn't solely a technical issue. This is a fundamental change management issue that's going to touch the technology, the operations, the human workforce management, the organization's culture. It's all of those aspects that need to be reconsidered in this new paradigm that you're describing.
And if I can, I'm going to go over here next. If we meant, like, a lot of the work we've done at Columbia over the last decade has been, how can we shift the advantages away from attackers, defenders at the larger scale, least cost? So we're reducing all of the defenders' dilemmas, and so that we've got the easier time and they've got the harder time. And so maybe the hot forest fire is one way of thinking that. But I like to put back an analogy of how we thought about climate the last couple of years, right? Certainly during the Industrial Revolution and probably even through Agricultural Revolution, right? If you wanted more growth, you had to do more pollution, right? And it was pretty correlated between GDP growth and pollution of, for example, CO2. And it's only been within the last decade that we've started to unhitch those a little bit in some economies. We've been able to continue the GDP growth, but the energy consumption of the pollution, well, maybe not the energy consumption, but the amount of pollution per unit GDP has flattened out and even decreased in some societies. What would that look like for us? Right, we've always had this, okay, the attack surface is going to go up, the attacks are going to continue to, the number of the attacks are going to go up, the severity are going to continue to stay high. And so what does that look like if we start to unhitch those in similar ways? We're able to continue to get the full benefit of these technologies. We continue to grow our devices, our attack surface, continue to bring large parts of the population who haven't been connected online, but the number of attacks go down. Right? And so I love to be thinking about that. And would that be the result of burning hot, in the forest? I'm not quite sure, but it's fun to think about and how we might get there. Okay, we'll go over here.
Yes. Thank you so much. So one of the questions that I had is we've been talking a lot about resiliency, especially with regards to AI risks. How do we support or how do we change the narrative when it comes to changing the bank? A lot of the initiatives are focused on run the bank. Resiliency is focused on run the bank. But with AI risks and this desire to adopt and move forward and faster within front office operations or revenue generation, how do we enable and support that?
Yeah, that's sounding like one of our CISO sort of questions here.
What bank do you work for? I know the answer to that question. Yeah, that's a good question. And I think part of the challenge is traditional risk frameworks aren't enough. AI is not just another technology to secure or regulate. It is a critical digital asset that will drive value creation as part of the digitalization strategy, which is not a security and risk conversation. It is a board strategy question. It's the fundamental job of the board to govern. And its effectiveness is going to depend on trust. So trust in the data that feeds it, trust who accesses and controls it, trust decisions it produces, and trust in the infrastructure that sustains it. So rather than controls to reduce risk, you're talking about guardrails that will allow you to innovate and transform and get full adoption within guardrails that assure trust and integrity. I think that's the way to do it. And that sounds very good and theoretical and academic, but I am at a university, so I can do that. What that means specifically is governance architectures that assure accountability, transparency, human-in-the-loop controls. And I do think human-in-the-loop controls are unavoidable. Well, I think those are part of your guardrails. For transparency of the model itself. Going back to the risk conversation that we had earlier, some person's accountable, but also and understanding data integrity, which is absolutely important, so that you can trust both what goes in, what happened while it was in, and what comes out. I think the most important thing that you can have is clear ownership of trust outcomes, so that for all those different trust factors that I mentioned, everyone is comfortable that this adoption is staying within the guardrails. You do need to have transparency across the AI lifecycle, from data sourcing, model build, training, infrastructure protection, all that stuff. Redundant monitoring layers, so having agents watch agents, treating agentic AI as another insider threat, just like humans and third parties. Human in the loop for model training, agentic access and performance, high impact decisions, recognizing this is not automation of decisions, this is augmentation of decisions, and understanding the difference. But most importantly, one person in charge for saying, where are we adopting AI? How are we doing it? And what are we doing to assure the guardrails? That, I think, if you take it less as an innovation and adoption within guardrails question as opposed to a risk management controls, especially a risk management controls question from the perspective of a Swiss bank. So reduce the number of committees. But and again, it's very theoretical, but I gave some examples of what you want to focus on for the guardrails.
Yeah, excuse me. Building on that, I basically agree with everything Neil just said. It's about, and this is the case for cyber too, not just sort of enabling AI. Like I was at Chase when we called it the Chase Digital Initiative. We had a website before, but we weren't banking through our website. So this is like 2015, and really that generation of online banking. Big project, gonna happen. Okay, how are we gonna make that relatively safe, or which becomes in some ways an event. Like, you figure out what the guardrails you'd want are. You think about how much they'd cost if you don't get all the guardrail. You don't get to use titanium and you have to use steel, then you go forward, right? So that's just normal risk management of a technology-enabled business activity. So in that sense, I think it's similar. The other thought I would add, because I know two CISOs, one in a U.S. institution and one in a Japanese institution, one of the most innovative Japanese institutions, who are responsible for the risk management of AI adoption. Both are very forward leaned into AI. It's part of their business strategy that fundamentally to become AI powered companies. What they both doing that I really like is they are allowing projects to proceed inside some pretty broad guardrails, and then learning quickly from what worked and didn't work and whether real risks emerge. So they're not saying, no, we're not doing this project because we went through some model risk framework and it tweaks 1 out of 30 things we don't. We say we need 30 controls and you miss 2 and we're not doing it. They're letting a lot of smaller project pilots go forward and consciously learning quickly from what they see in those. So I think that almost has to be the way forward. The pressure to adopt AI by all institutions is just going to get ever greater, or you're going to get behind. So you as a CISO or a risk manager, you have to find a way forward.
And I'll just say that Greg and I are teaching together this semester, and I see some of our students sprinkled around here. Use of AI to write your papers is mandatory, right? We force them to use it because we know they're going to be having to use it. And it's up to the students to review the paper that the AI has written and ensure that it is in fact accurate. And we see a big difference between the papers where the students go and they check the answers. Some of the students will write it in OpenAI and then have Claude do the fact checking, and then students that don't do the fact checking at all, and they're going to notice the difference in those grades as well. Okay, so I'm not seeing any immediate questions. So let me do one final question and then we'll close. I'm really surprised because I see articles that are written that say boards need to take cybersecurity and AI and related risks is a board issue. It's no longer an IT issue. And maybe because I'm in New York and maybe I'm talking to y'all when I was in your CISO hats. And I'm like, and I talked to Trish, right? Like, what boards aren't doing that? How is that still a hot take that someone's going to publish an article that says that? So this is a conference on the cyber risk to financial stability, right? And so if we're thinking about that as financial stability, right, not just, so now I'm kind of asking you as consultants on the ends, and Marina, you're with the Office of the CISO of Global Cloud, and your office is out there talking to these CISOs. Is it generally accepted by the boards, not just the ones that I can see out the window here, looking south at New York? I've got a better seat than you do, Neil. And is that generally accepted not just at the major New York banks, but generally through the finance sector for the boards that they need to be taking it that way? And maybe we'll just go down whoever wants to take first, and then we'll just close with any final thoughts.
I think in the States it's unavoidable because of the way regulators, are, right? So, boards realize that just managing regulatory risk is largely a cyber digital, enterprise. So they're paying attention, right? They may be over-indexed in terms of cyber means not getting any regulatory findings sometime in the CISO. But I actually think there's relative sophistication in regulation, and at least for the big financial institutions in the States. So there's an alignment between what the regulators are looking for, and if they don't see it, they need to get fixed, and then the board's very much involved with that. And, I will say, that isn't the case around the globe. I would say in the jurisdiction I spend, a lot of my time in, I still think they believe the CISO is going to solve that issue, right? Which is a big problem for them. I just talked to Trish today, but I talked to the vice chair of one of the GSIBs, and he completely concurred with that notion. And he's having a hard time. And he was the former, just you probably know this person, he was a chief risk officer for Morgan Stanley before, right? So he sort of acknowledged that, in that jurisdiction, which is a very sophisticated jurisdiction. So if that's the case in Japan, it's probably the case in other places in the rest of the financial system. That's my observation.
So Marina, you're kind of an ambassador to so many of the CISOs around on behalf of Google Cloud, Office of the CISO. So.
Yeah, absolutely. And I would also mention prior to coming to Google, I spent the vast majority of my career in financial services organizations as well, working closely with CISOs and other CXOs. I think messaging like that is just worth repeating. It's not necessarily news, but I think it's something that definitely warrants repeating. And also, I think it's important to send the message up, but also make sure that the elevator comes back down, right? So it's a message the board should hear, but it's also a message that the board needs to push down to the various other executives to really ensure that they are, I think, providing adequate airtime to CISOs. And that's not the case in all institutions. Sometimes the CISOs have a seat at the table right away. Other times they're sort of called in a bit later on. And I think having that board support goes a long way in making sure that they're included in these very critical conversations.
Yeah, I have been a member of NACD, and I've been impressed with the magazine. Right, I mean, there's solid stuff in there. I would expect. I'm going to read these. The magazine from the National Association of Corporate Directors. That board directors get to, and I was thinking, I'll just read these so I can see what they're telling the kids, and I'm ending up getting smarter out of it. Like, oh wow, this is really good. This is teaching me more about my field.
I assume you talk about the article I wrote with Shelley in the NACD. I totally agree with what she said. It is sometimes some companies, their board gets a seat at the table, or the CISO gets a seat at the table. The CISO is heard. Other times not. Why is that? And one of the most enjoyable parts of enduring a regulatory exam, especially as a CISO of a GSIB, is trying to figure out what problem are you trying to solve? What problem are you looking for? And sometimes the regulators take a broad approach, so-called horizontal exam, where they know there's a problem, and everyone knows there's a problem, but no one knows what good enough looks like. So they throw it out there to the industry saying, tell us what good, this is especially true in financial services, which is a good industry to do that sort of thing. First of all, because of how regulated it is. Second of all, because they invented risk management as we've been talking about it. But even beyond financial services, the SEC, 2 years ago, 3 years ago, implemented their rule about the same time that New York DFS implemented their cyber rule on board governance of cyber risk. And the SEC toyed with the rule and ultimately discarded it that New York DFS kept in, which is you'll tell us who your board's cyber expert is, which director on your board is a cyber expert, or in New York DFS situation, you have to be either have a designated cyber specialist on the board, or you have to be advised by a cyber specialist. Okay, what problem are you trying to solve for with that? Because that's for the SEC, for all public companies to do that, they are regulating a position, and lots of positions are regulated by the SEC. The CFO is regulated; he has to be, he has to be a CPA. The general counsel has to be a member of the bar, so forth and so on. Now cybersecurity is regulated. That's the only regulated position that's not actually in the C-suite. And I don't know of any Fortune 100 company where the CISO is in the C-suite. It's a direct report to the CEO. So what problem are you trying to solve for? And the problem is sometimes why CISOs have a seat at the table, sometimes not, is you've got 12, 14, 16 extremely intelligent people who know the business solid and have the attention of a goldfish. And you have one person talking to them, and they don't understand the words coming out of the CISO's mouth. Now, is that 12, 13, 14 very educated person's problems, or is that the CISO's problem? The common link in all of your communication failures is you. So I'm thinking it's trying to solve a CISO communication problem at the board level, where I think the right solution for that is to change the position description when you're writing for the CISO and you're recruiting for a CISO, in that make sure in addition to all the different skill sets that a CISO has to be effective, which are myriad, diplomat, operator, engineer, businessman, spy, therapist, so forth and so on, they have to share two skills with every single person in the C-suite. They have to know how the company makes business, and they have to be able to articulate what it is they do for a living to the CEO and the board. And I do not see those skill sets in enough CISO descriptions.
Well, great. Okay, we are going to close out. So if you please thank me in joining in welcoming our folks.
Thank you.
Right off the start, when we get that right. And you guys can exit. Oh. Okay, thank you. Dan, why don't you just want to join us up? Yeah, go ahead.
So I just wanted to take a moment and say thank you all for joining. I think it was an incredible day. Hopefully you agree. Columbia, you put on a spectacular event. You always do. Thank you both Trish and Jay for the partnership that we have, and look forward to next year. I mean, the papers that are going to come out and the discussions that we're going to have. So thanks again.
Great. And thank you, Dan. Thank you, Danny. And just to close, to thank again to our sponsors, to Andesite. If you haven't been out, I don't know if they're still there, to take a look. We talk about what's AI on defense, and they're doing AI for the Security Operations Center, so please take a look. To the Data Science Institute, for the Institute for Global Politics. Thanks again to the team, especially my deputy, Irvu, who couldn't be here today, our event captain, especially the students that have been here. If you're a student, raise your hand. Great. If you're a student who wouldn't mind a good job or internship, please raise your hand. Okay, good. So thank you for all of that, and Trish, appreciate it. And we are going to continue. If you'd like to sponsor these in future, please do be in touch, and we'll see you at the workshops, or we'll see you next year. Thank you very much.